don't we do that? Let's officially call the meeting to order.
Governor Michelle Lujan Grisham.
Present, and thank you, friend.
Commissioner Stephanie Garcia Richard.
Here.
Treasurer Laura Montoya.
Good morning, present.
CFA Secretary Wayne Probst. Present. Nick Tejas.
Present.
Catherine Allen. John Bingaman. Present. Kelly O'Donnell.
Here.
Alan Sanchez.
Present.
Kurt Summer.
Present.
9 here. We do have a quorum.
Okay. Well, terrific, and thanks to those folks participating online. Nice to hear your voices. And we go to that next matter of business, which is approval of the agenda. Can I get a motion to approve? Get a second?
Second.
Mr. Bingaman, any questions, changes, edits? Hearing none. All those in favor, say aye. Aye. The agenda is approved. And we're going to go to the next item, which is item C on 1, opening matters, approval of the State Investment Council minutes from April 23rd. Do I have a motion to approve?
So moved.
Terrific, Alan. Do I have a second?
Second.
John, thank you very much. Any suggestions, edits, changes, questions? Hearing none. All those in favor of approval of the minutes for April 23rd, say aye.
Aye.
Aye. The minutes are approved. All right, we are on the second part of the item number 2 on the agenda, which starts with a briefing from John Corey.
So thank you, Governor, and thank you, members of the council. I know we have a lot of items on the agenda, so I'm going to be pretty brief. Just to give you an update on where we are with the portfolio, our total distributions over the last 12 months through April were just under $1.6 million, and our net asset value as of last Thursday was $53.8 billion. The New Mexico WTI price also last Thursday was $76.49, up about $6 from the same time a year ago. Natural gas is also up at $2.66 per MCF, which is up about 30 cents from the same time a year ago. Drilling rigs are down slightly at 107 versus 109, same time a year ago. And then I want to talk about the council retreat, because I know that's been a topic of great interest from council members. To avoid conflict with the upcoming special session, we're moving the dates for the retreat, and we sent out an email to all of you at the end of last week with some potential dates. If you could all please check your calendars, respond to us as soon as possible, let us know. We'd like to lock in a venue as soon as possible. We're also trying to line up some national experts to come and talk to the council and guide you through discussions of what you want SIC to become, what our goals should be, what our mission is. Also, I had the opportunity to talk for a few hours recently at an entrepreneurial ecosystem event. I got to talk with entrepreneurs, venture capitalists, angel investors, people representing universities, agencies, various other groups, and I've never seen such interest from people in the ecosystem of talking together, working together, and wanting to work with SIC to help build the entrepreneurial ecosystem. That's really encouraging. And that's something that our internal team has started talking about. Our internal team is now starting to have regular meetings with the Economic Development Department and with NMFA for how we can collaborate on building the entrepreneurial ecosystem and making things happen. The governance committee is also going to start talking about how we, as an entire entity of SIC, can do a better job of helping to build the New Mexico economy. Speaking of the governance committee, they have an upcoming meeting at 2 p.m. via Zoom next Wednesday the 5th, so a week from tomorrow. If any of you would like to attend who are not on the committee, please just let us know well in advance so that we can be aware whether or not we're going to get a quorum. But the committee will be discussing a lot of items largely revolving around how to make SIC a world-class organization from a governance perspective. This is something the chair, Catherine Allen, has a lot of ideas about that we'll be discussing. We'll also be discussing a memo with some ideas that I proposed, and we're going to have expert outside fiduciary counsel presenting to the committee and also there to answer any questions. So we're looking forward to that happening a week from now. Again, that should be a great start into diving into the policy of what we do as an organization, going to your point, Doug. And with that, I'm happy to stand for any questions.
Any questions for John? Remind me, the person who has the tenured person, where is the retreat? Is it gonna be in the?
So,
Give me a sense of where
Governor, we're planning for the retreat in Taos Ski Valley. It depends.
Oh, that must be awful. I'm so sorry.
Well, we want to make sure that we get everyone there. But it will depend partly on which dates people are the most available. Not all of the dates that got sent out are dates that location would be available. Again, that's why we're trying to nail down dates, because a lot of people are scheduling events, weddings, things like that. So we want to make sure people want that.
Understood. All right, if we don't have any questions or suggestions in the Executive Director's report, let's go to the Chief Investment Officer's report. Vince?
Madam Chair, and good morning, everybody. Last January in our meeting, during this discussion, we talked a little bit about that in a presidential election year, particularly
It's a presidential election year?
so you think it that way, and particularly when an incumbent is running, the economy tends to be pretty good. Markets do okay. The Fed is usually quiet. It's just in that particular year, those things kind of come together ahead of the election. 5 months in, that's how it's turned out. So we're halfway there to the election, and the economy's been really pretty stable, not high growth mode, but unemployment in particularly has been at really good levels. We're seeing very strong consumer activity out there. Real wages over the last couple of months have actually grown, which we always like to see.
Who's in the top in the country for wage growth?
Okay.
But who? Which state?
Oh, which state? I don't know.
We are. Just thought the State Investment Council should know that. It might have shifted in the last quarter, since it's a pretty tight race, but this council should know that New Mexico has that spot for a good amount of time.
Yeah.
Number one in the country for race growth, and still one of only a couple of states that's moving out poverty at a steady clip.
Yeah. People are still a little bit behind from the inflation we had earlier in the year.
Yeah, it's not going as far for sure.
But at least the last 2 or 3 months, starting to catch up. At the beginning of the year, economists were calling for as many as 6 Fed rate cuts. That's 0. So it's been very quiet up to this point. So a lot of things that tend to play out in a presidential election year, are played out at least these first 5 months of the first year. All not perfect, of course, and I mentioned that wages are starting to grow right now, mainly because of the prior inflation. And we have a service called Strategas, excellent chief economists there. They did a study on inflation around the world over, I don't know, probably a 40, maybe 50-year period. Several different countries all over the world, inclusive of the United States. And inflationary periods like we had earlier this year tend to come in 2 ways. So you get that initial burst for whatever reason, you got that burst, and in this case it was a lot of the money that was dumped into the economy over the COVID period. That all came to roost. Got inflation up almost, we're at 99%. But central banks start acting, inflation comes down. But because people were still behind usually from the inflation, so the price level has risen, but their incomes have not risen as much, then comes wage demand. And particularly in an environment like we have, with a pretty tight labor market, that's where we're seeing the growth in real wages. That can light off the second wave of high inflation. So it's come down, and the latest chart that they put out is tracking the other 3 inflationary periods in the U.S. is tracking those. So we're just starting to definitely keeping our eye on the inflation rate, because historically we get another wave. That will come this fall, timing wise. So keep our eyes on that. Otherwise, stock market's still doing okay for us. Returns aren't terrific over the last 2 years. On the stock market, we're still about 5% compounding annually, beginning of 2022 all the way to the end of the quarter, March 31st. In fact, a little under, wasn't it, Brian? Yeah, they're slightly under 5%. So we've earned that with our cash. But still, it's chugging along so far. And there's a little bit of risk still in the market. We talked about that in January too. That there's a handful of stocks that are delivering made a good cash to work, from all the inflows that we've had. Portfolios, risk assets are building at a good rate. Asset class directors are caught up on basic models so far this year. And next month, we should have the annual investment plan for you. I think it'll be the 13th or 14th. But it's quite a doc, and we'll have that ready for you.
Thank you. Any questions, anyone? Suggestions? Observations? More than mine? There was maybe also whispering that inflation is now lower than 9. Don't just, and I don't have the expertise to be able to project out. Then the reason I would know that is that I'm always fighting with the hospitals about what their inflationary and cost units are and should be. But thank you very much. All right, we're going to go to Vince. Oh, I'm sorry, we just did that. Performance report.
Yeah, so we'll just pass right to Marty K.
Yeah, sorry about that, Vince.
Well, thank you, Governor. It's nice to see you, and thanks for the comments on the market. We do have two reporting items in your packet, the March flash report as well as the executive summary. We'll focus primarily on the executive summary. As always, I'll start off just by a few brief comments on the capital market environment as it relates to performance of the underlying asset classes that you'll see. It's touched on a lot of it. Page 15, you can see the snapshot, all the relevant economic indicators, market performance, on the bottom right-hand side, and then as well as the yield curve. All the key topics that we've been discussing for quite some time. If you look at the bottom right-hand side, that page, you'll see the market performance table, trailing returns for all the major asset classes. At the top, you have your equities, middle section, your fixed income and cash, and then down below your alternatives or diversifiers. And pretty quickly, you can see as you're looking across the column, MTD again is month March, and the first quarter, QTD, calendar year to date. That's self-explanatory. See some reasonably positive numbers, especially across the equity market. S&P 500 still leading the way for a lot of the reasons that Vince mentioned. Concentration in market leadership and strong performance on a handful of names. So by and large, reasonable returns, and not just for the month and quarter, but as you look further out on the trailing period as well. This first quarter, overall pretty good, certainly, as I said, for risk assets, but building on what we saw and we realized most of last year, although it's been now without the volatility within that. Much of it has to do with the labor market and the economy remaining quite stable, surprisingly stable, despite the substantial increase in interest rates, and touched on that. It's welcome to see those kinds of numbers, but it is a tough balance in terms of getting that mix right. Certainly a lot of eyes on what interest rates are doing and how they're impacting the markets overall. So far, I would say the impact has been less than or more benign than originally anticipated. In the fixed income market, you can see the yield curve changes on the top right-hand side of that page, different points in time. What we witnessed for the first quarter was an increase in interest rates. That, of course, had an impact on really any interest sensitive asset or duration sensitive assets, so those tended to underperform those assets that had higher quality and perhaps were more floating rate in nature. That being carried throughout most of the investment. Talked a little bit about inflation and the moderating of inflation, somewhere between 3 and 4%, depending on what measure you're looking at. Certainly still above that target of 2%. That's going to have some implications. As mentioned, beginning of the year, we started out with expectations for rate cuts somewhere 6 or 7. That seems pretty ambitious. Kind of best case scenario so far. Had none. Most recent comments from the Fed are maybe 1 or 2 the second half of this year, but it really wouldn't surprise me if we saw none for the remainder of this year. And I think generally can expect a more measured and incremental approach to interest rate change. It's very difficult to go the other way and whipsaw the market on that. And you'll probably recall prior conversations that collectively here, happy to take any comments or questions with Marshall.
Any comments or questions? All right, let's go to Marcia. Good morning.
I'm going to take you to page 48 in the and go to the executive summary. And again, the executive summary is designed to be a policy review of those targets, asset allocation targets, and performance objectives in your investment policy. Try to simplify them and show them in this executive summary. So on page 48, we begin this discussion on asset allocation. Asset allocation is the primary driver of your return. So you set a target, you want to reach your target. You'll notice then as we go through the allocations and you look through the allocations, some of them have interim targets, and that's just a reflection of an increase into private investments, and that takes a while to deploy or get those assets invested. So an interim target is set, and what we're showing you here is where you are against the interim targets, but we do show the long-term targets as well. So on page 48, we show you land grant and severance, and the story is pretty much the same as what Vince has talked about, although you've gotten closer to your interim targets, but during this period of deploying to privates, you do have a balance in cash. Cash is actually paying well now, and you suspended your targets on core fixed income during this period as well. So you'll see on land grant the overweight there to core fixed income and cash equivalents. However, mostly green boxes, telling us that you're getting very close to your interim target. And in fact, the red box is pretty close. It's 0.1% away from being in that range. So severance, the same story is true. You can see the underweight to the private asset classes on the right-hand side of the page. Again, more green boxes, so working to get that cash deployed into the private investments. And I think Vince just said that their staff, asset class directors are at their targets for pacing. On pages 49 and 50, you see the other funds, many of which are solidly green. And on page 50, just pointing out that the opioid and the conservation funds that did have interim targets are now at target, and you'll see a red on conservation, but that's in the private market, and you're at your current, it's just a matter of rounding. Actually, you're over. So again, that now is at your long-term target. Now we'll go back to allocation, driver of return. Now let's go and start looking at did you meet your policy objectives for performance. Page 52, we look again at land grant and severance first. And land grant, your investment period in your policy is 5 years. So you can see a red yes in the box that it has met its policy objective on land grants for that 5-year period. Down at the bottom of the page, you can see land grant and showing both gross and net against the policy index, and short-term and long-term beating that benchmark. Severance tax is a little different story, underperforming for the 5-year policy expectation. But short-term, you can see that it's actually outperformed its benchmark. But this is historically, you've seen that, again, not at your target allocation completely for either of these funds, but land grant exceeding its objective. Page 54 is land grant attribution, and so again, explanation of where the return came from. The green line is your performance, the 1-year performance for the land grant, 9.56. The blue is what you can attribute to your strategic, in this case, interim allocation at 9.09 for the primary driver of return, again, is a strategic asset allocation. Being away from your target, which is represented by the yellow line that says tactical asset allocation, that's just saying, are you away from your target? And you know you've been away from your target, trying to get the privates deployed. So in this case, for land grant for the 1 year, that was a bit of a headwind. And if you look down below, you can see where that came from. Came in part from public market fixed income, not at the allocation, and real estate was actually a positive to that because you were underweight real estate, so that was a positive to you, but in total, detractor not being at your target allocation. Being not positioned exactly like your benchmark, that's strategic, that's the FS, that was pretty neutral, but you can see for the year, 110 basis points of manager value add came, again, from each of the composites we're showing. The only negative here was your private market fixed income, and remember that's in a changing phase, and the benchmark was reset, so that's the only place that you had underperformance for that 1 year period on the attribution. Let's, 56, this, same information for severance tax, a little bit different story here. Again, the bulk of the return came from your strategic allocation. Being away from your target allocation was actually a positive here. If you look at the numbers, being, again, underweight or not at your target allocation for real estate was a positive. You're underweight your your state program on private equity, that was actually a positive for this period. Again, not being positioned exactly like your benchmark was neutral. And in this case, you can see a slight negative on manager value add. And we've done something different on this report. This report, we're showing the national private equity and the state private equity program. And if you go down to the state private equity program, you can see a negative there on manager value add of 0.55 in performance there, not meeting its benchmark. And again, a negative on private market fixed income, which we know there was a benchmark change and still in the process of funding. But also some target positives there, the national program, a positive, as well as slight positive on your public fixed income. Looking at your, this is the next schedule is what we call schedule in investable assets. This is for the calendar year, but what's most notable here is looking at the net cash flow across the board. The top line on page 57 is all of your funds, so that 2.9 billion of net cash inflows, and then strong investment gains as well for total funds. You can look down at the individual funds that you're responsible for and see those that have net cash outflows, but strong inflows for total. Let's go to page 60, just a reminder that your objective is how you do against your peer. It's not an objective in your policy, but we do show that in the quarterly report. On page 61, we do list what your objectives are for the policy: to provide annual distributions, to protect purchasing power, and to provide some growth. But we do then below that show how you've done against your peers. And as Vince said and Mattia said, the quarter was stronger return for equities. You are more diversified than many of your peers, so you'll see a rank of well below median for the short term. But if you look at 3 years and beyond, you're at median or above median. For the 3-year, you're 13th percentile. For the 10-year, you're 39th percentile. So above median for longer term, which is where you want to be. Your diversified portfolio. Looking on page 62, this is looking at 5-year rolling ranks and beginning with 5-year look back from 2000 to this current time period. And the right-hand side of the chart shows, for the most part, you've been above median. That's where you want to be, above median. You have, in periods where the strong public equity markets, you've fallen below median slightly. because you've had a more diversified, more defensive portfolio. But much better look than the prior years. Page 63 is looking at the Sharpe ratio on a 5-year peer rank, again, rolling period. And this is really just an indication of how much return you're getting for the risk you're taking. And you can see in that case, you're the top quartile across the board for the right-hand side of the chart. We have the same information for severance tax. I was going to skip that and go to page 66, which looks at risk return. For the land grant and severance, we typically show the $10 billion universe too. We didn't have that. Universe was not complete yet, so we're only showing you at this point the greater than $1 billion. The land grant, you really can't see the diamond. It's under the yellow, so that your actual land grant performance is under the yellow, and then the severance tax is the blue, actual returns in the orange is the policy index. So you have below median volatility, and the land grant actually as close, very close, or at median, a little above median for that 5-year period. And it has done it at obviously less volatility. Looking at the 10 years, the same story is true, above median performance for land grant, and got there at less volatility despite the strong equity markets. And for the 10-year period, you can see severance tax a little bit closer to the median return line. Asset class performance, I'm going to skip you the page. In this instance, we're comparing the asset classes to the policy benchmark in your IPS. First, we look at U.S. equity and U.S. equity on page 29. First, I want to say there were no changes to the U.S. equity portfolio, that you did not meet your policy objective for your U.S. equity portfolio. You can see the no there. You trailed it by 52 basis points for the 5-year period. Couple things going on there. Again, this market that was driven a lot recently by a few stocks. You also, for a good portion of that period, you still a little bit have a little bit more small cap in the index. And if you look at the your U.S. large cap composite versus the small cap composite, you can see that U.S. large cap composite was had a much higher return than small cap. Historically, small cap has been better over the long term, but in this period of a narrow market, large caps did much better. So that drove part of the underperformance. But you can see short-term outperformance against the benchmark of 1 year, very much at it for the 3-year. If you're interested on the following 2 pages, you can see that on page 72 on the risk return, you're in that northwest quadrant where you've had above median return and below median volatility. And on page 73, just looking that you are very close to your benchmark, both on sector and market cap. Non-U.S. equity, Greg came to your asset class, or actually came to you, and is going to be making some changes to that portfolio. So you can see that that non-U.S. portfolio has outperformed your policy benchmark. So just some tweaking and improving, but you have met your benchmark for there. If looking at page 76 and 77, just some characteristics, risk return, Greg went through a lot of that with you recently. So let's move to fixed income. Page 79, again, no changes. You went through a structure study on your with fixed income, your public fixed income, calling it public now, has met its benchmark. You can see that at the top nicely, 120 basis points above. Your private, although we've seen underperformance with the benchmark in the short term, if we take that composite and look at it against its benchmark for the 5-year period, it's outperformed its benchmark as well nicely. And just a reminder, if you look at the return for the public fixed income versus the private, understanding again that diversification and having both public and private, that the private has added value and outperformed the, public fixed income. The rest of the report is looking at your alternatives. Your specialty consultants come in and talk to you about this, so I wasn't going to go into detail. A little bit longer performance there, but this is your quarterly review, and we'll take any questions.
Any questions, comments? All right.
Madam Chair.
Oh, yep.
Good morning. Madam Chair, Ms. Marcia, on page 48, can you just remind me on the public markets? We have NA, and I see on the bottom it says denotes a suspension in target range limits. What were the limits that we had on there? And I know we're planning on changing them, but what were our minimum and maximum for the public markets on the asset allocation for land grant?
On 48 for these. So those are the I'll look that up and give it to you. I can pull that up and I can email you. I'm sorry we don't put that in, but when those were suspended, but we should put note what those were. I'm sorry, Treasurer I'll email that to you right away.
That's okay. I just was wondering, based on the review of the investment policy changes and the asset allocation changes, if they were going to be higher or lower. I think that we had decided that the public market was going to be lower, which is why the interim target was 16, but I wasn't absolutely positive. Maybe Vince, can you remind me?
The core fixed income allocation was lowered. And that long-term target, it was lowered to 6%.
Okay, thank you very much.
There's agreement here. Madam Treasurer, will that suffice, or do you still want, and if we're going to do something to put that, and we should, that question, the answer in writing, give it to all the members so that we're all caught up. Good question, Treasurer.
Thank you. And one last question. I know that we were looking at data on our portfolio regarding diversity, equity, and inclusion within the portfolio. What is the status update on that?
We are putting the information together, and we can give it to you. I think we can turn it around. We've collected it. I think we can turn it around as however, in whatever format you would like to be presented.
Okay.
Madam Chair and Madam Treasurer, I think our goal is to have that in front of you at next month's meeting.
Thank you. Thank you, Madam Chair.
Thank you. Thank you, John. All right, any other questions, comments? All right, seeing none, we will move on. We are now on item 3, investment matters and portfolio recommendations on the agenda. Item 3A is an investment committee report. And Ms. Smith.
Governor, thank you. We had a meeting last week. It was very positive. We had a quorum for the meeting. Appreciate everyone who attended. We did recommend all of the voting items to the full council unanimously.
Any questions, statements, comments? Thank you very much, Tom. We're on item B. That is going to require a vote. It's the strategy asset allocation. So we're going to go back to RVK.
I'll go ahead and kick that off.
All right, that's fine.
Yep, okay. Well, let's start on page 93. First, this report that you have in your book, we've got some descriptions of what this new fund is. The statutory language is in the back. But I wanted to start you on this page because as these new funds have come into us, we've tried to build a structure around it in terms of the asset allocation that we've decided. So some funds, like on the left-hand side of the chart here, the water fund, we can put these into some pretty high growth investments. It's just based on their distributions and the stability of the principal in terms of flows. You can go to some higher growth investments. Land grant is next to it. Just slightly less. Land grant has slightly more liquidity requirements, not quite as much private investment. So really, the difference between the high growth investments or high growth allocations and growth allocations are a little bit more in publicly traded equity. lot of the parameters that are around the higher education trust fund look to us like, so we think a similar allocation or the same allocation as one that fits. So you can see, substantial growth assets in it, 40% public traded equity, 10% private equity, so total 50. But a little bit more, fixed income, just to provide a little less volatility, a little bit more cash flow to make this. But I just want to start with that, show you the framework that we've come up with as these funds come in, for how we slot them, in terms of building those assets. So let me turn it over to TSG as you comments you with it.
Sure, yeah, thank you, Ben. Exactly right, and we have the executive summary on 92. The key points there is 5% distribution and the potential for some appropriation, which is driving the liquidity, the need for liquidity with the flight bill. So we went into that, and as we do whenever a new fund comes online, we look at the bill collectively with staff, and very good at dissecting the relevant pieces and understanding where the key points are and where it should fall within the spectrum that Vince mentioned. That's a newer addition over the last 12 months or so, as the number of funds has continued to increase. We wanted to think about them in terms of what their purpose and constraints are, rather than just the name itself, and that's where we've come up
We
with
just need the DFA secretary to stop telling the legislature they can just create, I don't know, like 100 funds, a legislative session. Nice job.
So
It's good news.
Yeah, it is.
So we have enough
and
resources.
this is our attempt at, collective attempt at trying to streamline that, and I think it's been effective. So exactly right, it is a growth fund with a tilt more towards liquidity to be able to generate that. This is a bigger fund on the spectrum of the newer addition. So historically, land grants have been a source of liquidity, but that also can only go so far. So there has to be some inherent liquidity built in. EC has been a great allocation, as we're calling that. You see that in purple, and we think it addresses the objectives as it's written in the bill quite effectively. So you can see on 95 just kind of how it falls, and 10 portfolios across the top. Visually, you can see it on 96. And as you look at that, it's very close to the efficient frontier. So we think that's a good portfolio. Question, as you look at that, might be, well, why not portfolio 7, for example, which is ever so more efficient? And portfolio 7 just has less than the traditional assets. So it has less than public equities, less than public fixed income. By doing that, you would just have less liquidity. And the give up between portfolio 7 and ECE is 10 basis points in compound return space, and that's pretty minor when you consider the possibility of appropriation by the legislature. We want to make sure the money's there, not just as well. So we think this strikes a great balance, and we're comfortable with it.
Any questions, comments? All right. Seeing none, do I have a motion to approve the higher education trust fund strategy? Allocation strategy, yeah.
Yep.
You got some language in the motion. See, it's been a while. Yes, sir.
It's a mouthful. Based on the recommendations of the Council Investment Committee, General Consultant RBK, and SIC staff, I move that the State Investment Council authorize the asset allocation plan for the new higher education trust fund as memorialized and discussed by the council at today's meeting.
Second.
2 seconds, thank you both. Any questions, comments? All those in favor? Are we going to do a member by member vote, or how would you like to do this, Brent?
Madam Chair,
Yeah.
we have to do a roll call because we're hybrid.
Yeah, I thought so. That's why I was asking Brent. Thank you for reminding me. Let's do a roll call.
Governor Michelle Lujan Grisham.
Yes.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Props.
Yes.
Nick Tejas.
Yes.
Catherine Allen. John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
9 votes in the affirmative, motion passes.
Thank you. All right, good job, everyone. Let's go to item 3C, which is the strategy risk report. Are we going to start with you again?
Just very briefly, Madam Chair, so as you know, we've been working for quite some time with the Aladdin risk system, getting some really good reports out, and so you're going to see McConnell on a fairly regular basis, on a regular basis going forward.
All right, thank you.
Thank you, Madam Chair. So this is the Land Grant Permanent Fund Risk Report for March 31st of this year. Let's dive into that. Starts on page 102 of your materials. So on a very high level, the volatility of the portfolio is 12.6%. Volatility of the benchmark for the same period is 9.2%, which results in a tracking error of approximately 4.6%. Now, this number is within the tracking error limit range that we've set up for this fund, which is from 4 to 6%. So you can see that 4.6 is within the range, and it has been consistently within the range over the last couple of years. Now, there are no surprises as far as the active country allocations and active currency allocations are concerned. Again, not surprisingly, about 75% of current portfolio volatility contributions as well as tracking error contributions are coming from 2 asset classes, the high risk strategies such as public equity and private equity. So no surprises there. As far as the active allocations are concerned, we are a little bit overweight in the financials. So if you look at the second row on the chart, all the way to the right, we have a little over 1% over-allocated to Bank of America and also 1% over-allocated to Morgan Stanley and Citigroup. Now, the rule of thumb when we speak about the active allocations is you want to be within 2.5% on the relative basis, relative to the benchmark, or you don't want to exceed the 5% if you speak about the absolute value. So we can see that we are well within the 2.5% range, and that pretty much means that the concentration levels remain reasonable, and the portfolio continues to exhibit their very high levels of diversification, which we are happy to see. Jumping into the tables in the lower end of the page, so we see that the portfolio beta is 1.26. It's virtually unchanged over the course of our observations, which has been about 2.5 years. It pretty much means that our portfolio is relatively aggressively allocated compared to the market portfolio, the benchmark. Also, the portfolio risk has decreased over the last quarter by 1.4%. So we went from 14% to 12.6%. And if you can see it, that volatility 1 quarter change right in the middle, it's all red. As a risk person, we're really happy to see that. But we would like to understand why exactly there is a decrease not only in all the asset classes, but in the total portfolio as well, because this is really important. So there are 3 main reasons for that. About 75% of the decrease in risk can be attributed to the model recalibration. BlackRock has recently rolled out a new risk model for private credit. They have also updated some private asset classes risk models, so that brought down the risk quite substantially. Now, the second biggest reason for the decrease in risk is the fact that 53% of risk is coming from all the private asset classes, and this information is lagged. So in the second quarter of 2023, we've had about 20 new allocations in risk assets, and the risk profile of those allocations is much lower than the ones that we've already had in the portfolio. So in total, it dragged down the risk numbers quite a bit. And the last reason, but it's relatively small, there is a slight decrease of risk in existing allocations. So the way it works, the model updates itself going forward. So from the end of last quarter up until the end of Q1 2024, the model has updated itself, and there was a slight decrease in private credit and private equity allocate risk in those sub-asset classes has decreased slightly due to the model updates that have been taking place in those areas. So those are the 3 main reasons of why we see the reduction in total portfolio level risk. Also new this
quarter is the fact that we have come up with the budget, second error budget for each individual asset classes. So as I mentioned before, on a total portfolio level, we are looking to be within 4 to 6% second error. And you can see pretty much the breakdown for all individual asset classes. Now, there is no real science to that. It's a combination of multiple factors. It's academic research, and we also look at the peers. We also do some analysis internally. So those are the ranges that we would like to stay within. Now, in the short term, if one of those ranges is breached, it's fine. We can always live with that and if we can explain it. But we don't want to see consistent breaches, or we don't want to see those numbers breached in the long term. So we're just keeping an eye on that. The next page, not going to spend too much time on that. So those are, as we keep using the model, we build out the history. We can already look at some trends. So a couple of things here. The first one is marginal contribution to risk. In simple terms, this is something that helps us answer the following question. If we increase allocation to a certain asset class by 1%, by how much will the total portfolio level increase? Again, comparing that to Q1 last year, at the end of Q1 this year, the primary drivers of risk are the same. So public equity at 1.21 and private equity at 1.69. So essentially, if we increase allocation to private equity by 1%, the total portfolio level risk will increase by approximately 1.69%. As far as the risk-adjusted returns are concerned, so this is done just primarily to build out the history. We need a little bit more data points to do that. But for example, in Q1 2024, we know that the public equity has performed really well over the last 12 months. So per unit of risk that we take in the public equity portfolio, we earned 1.41% of return, which is pretty great. Then public equity is followed by public fixed income and private credit. In that scale, once again, this is just a floating number. We like to look at it, but we would like to see a little bit more history in order to make some better statements or talk about the trend. Now, the next page is actually what's really important. So this is the scenario analysis. Just a quick reminder, we looked at 10 various scenarios, and we like to capture different shocks to the system. So as you can see, we have things like pandemic, we have shocks to the commodities market, we have some global conflicts, et cetera, et cetera. So we would like to shock and stress our portfolio from various different ways. The rule of thumb here, you don't want to see anything less than 25%. So if the portfolio return is negative 25%, it is something that you have to start looking into. As you can see, portfolio return, the highest drop, the biggest drop is about 20%, shown by the SIC-2024 scenario. Now, this is not a cause for concern, but we like to understand why is this number relatively big and close to 20%. So if you look at the SIC-2024, there is about 14 underlying shocks that comprise that scenario. And the biggest shock is the S&P down by 30%. Now, given our allocation in land grant permanent funds, 30% drop in public equity is about 13.5% drop in the total portfolio. So we can see that out of this 19.7%, 13.5% is explained just by one shock to the system, and the other 6% is explained by various other shocks such as profitability drops, commodity market drops, et cetera, et cetera. So now the probability of exactly this scenario repeating itself going forward is very negligible. So, the conditions of taxation of 1974 happening again in the future might not happen, but nonetheless, we like to, again, stress our portfolio using different scenarios, see how it behaves, and in case we see a major drop, we'd like to understand what exactly is driving it and how can we reallocate going forward so that we can avoid that. And the last but not least, and I don't want to bore you to death with this, but this is just an example of what we are also looking at. So we have one-pagers for every individual asset class. So we look at risk of public equity, fixed income, et cetera, et cetera. This example of the public equity risk report that we look at. Again, don't want to spend too much time on that, but just wanted to mention that we run our portfolio through two models. One is the global macro risk model, and this is the lower table. So what we like to see here is the fact that as far as the factor exposure is concerned, we are exposed to economic growth, emerging markets, and real rates. Now, if we try to understand where exactly is the risk coming from, we can see that idiosyncratic and residual attributes to the biggest parts of that volatility. In order to understand that, we start running our portfolio against the dedicated public equity model. And over there, we see a lot of risk coming from the style factors. So you can see that the standalone factor volatility and volatility contribution from factors style attributes to about 13.2 out of 15.8%. So the vast majority of that is coming from style factors. Now, in their terms, style factors, this is something that the groundwork was done by Fama and French in the famous three-factor model back in 1990s. Then it was expanded to 5 factors, and BlackRock Aladdin is actually looking at 18 different factors. So once we dig in, we see that most of the risk within that factor comes from momentum, size, and value. So why do we do that? We can take these numbers, we check those with our managers to see that we align, and then we don't want to be overexposed, so we don't want to have a source of risk coming primarily from 1 or 2 factors. We want to be diversified within the sources of risk. And if that's not the case, this is again something that we revisit with the manager and internally to see if our allocation can be the cause of that. With that, I will be open for questions.
Thank you very much for your report and presentation. Do we have any questions? Great. Seeing none, we're going to go on to the item 3B, which is the intergenerational equity analysis. Vince, do we want to start with you again?
Yes, ma'am, thank you very much. So this report, Don's coming to the table, I'm sorry, we didn't get her on your agenda. This report, I think we first delivered this in 2014. And the objective of the report really is to evaluate the fund's performance based on the policies that are related to it. So does that investment returns and asset allocations and all that really fun stuff. This report mainly talks about how the funds are performing relative to the policy expectations that we have for the reason that they exist. It's really come a long way since that first report back in 2014. Currently, Don on our staff leads this for us. Probably the most important input to the model or to the whole intergenerational equity is expected inflows. Get that right, and that's Don does that for us. That's all of us. She's joined and is actually leading the intergenerational equity now. And then Matthias and RDK do all the statistical work.
All right, thank you. I go to.
I'll let, thank you, Governor and Council. I'll let Marcia and Matthias kick it off since this is their model, and then I just have a few follow-up comments.
Okay, thank you.
Perfect. Yes, I would begin on page 107, and it's exactly right. As Vince mentioned, intergenerational equity model is comparable to asset liability study in the pension world, where really the only analysis that doesn't just look at the asset side, but also the liabilities, how those interact. So getting a holistic picture of all the various inputs. And you see here at the bottom there's the 3 components that contribute to the fiscal health and trajectory, and those are both important. Where are you today, and where are these funds going over time, based on these inputs. The spending policy, of course, so that's distribution, money going out, the contribution or inflows, money coming in, largely from the land office, and then the investment returns after inflation. Those are 3 distinct levers that all interact, but they all are unique in the way that they impact the long-term fiscal sustainability, and also really the only lever that this group can impact directly is the investment return to the asset allocation. Inflows are what they are, and the distribution policy is are, is really the one lever that can be directly pulled is investment returns. So they're not created equal, and I think that's important to keep in mind. In terms of intergenerational equity, I think that concept everyone's familiar with, allocating equity, trying to make sure current and future generations have similar opportunities and funds available, and trying to do that and be very mindful about looking down the road and finding the trajectory, because if you get in bad shape and you're only realizing when you're already there, it's too late to act. So this is having a lot of runway on these things is quite important. And this analysis, like any analysis, is not perfect. I think we have a fair amount of humility, but it's I think a pretty good effort in terms of trying to see what kind of path each of these funds are on. On 108, we're defining the intergenerational equity objectives. What is it? Well, in its simplest terms, and we have it listed here, it's preserving the economic value after inflation. So essentially, maintaining the purchasing power, being able to have the same worth and value for those dollars today as they will be in the future, and then a little bit of a growth premium in there to account for, well, both the declining nature long term of non-renewables, but then also the greater demand on those assets, whether it's population growth or other things. So it's a bit of a additional growth factor of just 0.5% that we have in there. What you'll see throughout this presentation are scores. Essentially, and these scores, as we look at them, there isn't a perfect score. 50 would represent having an equal probability of achieving that objective versus not, and does a good job of balancing current and future generations. Just because you're above or below that doesn't mean something is inherently wrong. It furthers additional conversation and discussion, understanding around why the score is the way it is. You can see the beginning fund values and their target values 25 years out, based on maintaining the economic value after inflation and the 0.5% growth rate. You can see the beginning and the end point there, and these are in real terms, so that is adjusted for inflation. Started out just with land grant and severance, and as with the other funds, have started adding, trying to get as much data to you as possible. These additional funds that we've added were conducive to the studies because they have similar components in terms of distribution policy, similar characteristics. So they lend themselves to being able to be measured here. On 110, you see the spectrum of scores. And you'll see some that fall below 50, and in some cases well below 50, and others that are well above. And that's largely driven based on their inflows, how meaningful the inflows are relative to the size. And one thing that I think is important to keep in mind is that you'll see that as you dig into maybe some of the slides later on, that the inflows are not expected necessarily to last into perpetuity. There's some funds that are expecting more meaningful inflows over the short term, and then others that will experience those inflows for a longer period of time. But those that do have meaningful inflows, even for a short period, are the ones that are benefiting from that higher score that you see. So the point there being, just because it's higher doesn't necessarily mean it's a call for action. It's just trying to say, okay, there's a concerted effort to get additional funding. The economic environment lends itself to additional inflows from oil and gas. These things can have benefits down the road, but it is having some implications on the values that we're seeing for intergenerational equity and exports. And a lot of that, you have details on the subsequent pages in terms of what the expected inflows are. Dawn is on top of that, updating it all the time as that information is coming in, and so that information, of course, is reflected in real time in our expectations for returns on the asset allocation changes. These are all inputs that will drive these scores, and so it's not necessarily about for X versus Y, but is it consistently going one way or another way? What does that mean in terms of understanding the overall trajectory of these funds? Do a tremendous amount of stress testing around that, trying to see how these scores would change based on changes, and recognizing that a lot of the scores are quite sensitive to expectation. And inflows is probably the biggest one, especially those where the inflows are meaningful, and even minor inflows for those funds that don't have any inflows can make a positive change as well. So these are the kinds of things that we look for. So this analysis on the subsequent pages is in stochastic terms. There is uncertainty modeled within that through Monte Carlo. You can see that detail there. Land grant is well above 50, somewhere in the 80% range. You can see how the distributions are expected to materialize over the next 25 or so years on page 114. By and large, growing, and over the next decade plus.
Excuse me, someone needs to mute.
On there twice, Christopher Rodriguez.
On page 115, just to finish the lay of the land here for each of the funds, and then these pages we follow for each of the individual funds is a composition of various components and how they're contributing to the score over time. And you can see for land grant, for example, that inflows and investment return are quite meaningful over time. Of course, you have distribution, a constant outflow, and then the net impact over time increasing. Return is fairly stable over that period, but the inflows as a percentage of the beginning market value are decreasing slightly over time. So that's in part noteworthy for the differences in terms of what that means to IEI going forward. I'm happy to go and discuss some of the other funds, or happy to take any questions or comments. Don might have some additional points to make.
Yeah, go ahead. Madam Chair, members of the council, I have a few just additional comments to make, items to point out on some of the specific funds here. The first thing that I think is important that we all understand is what exactly is the intergenerational equity score. So the score itself, the number that it produces, is just the probability of maintaining that objective. So the probability of maintaining a flat economic value with 0.5% growth over time. So does it have the same spending power today as it would in 25 years? However, on its own, without any context whatsoever, the score itself doesn't really tell us anything if we don't know what the goals of the fund are, what it was intended for, what it was created for, and the circumstances around it. So it is important to be cognizant of what the goals of the fund is, and then what the scores tell us is whether or not the trajectory for that fund is directionally consistent with the goals of that fund. And so, for example, I'll point out for the Severance Tax Permanent Fund, that has a 93.6 score, so very high. There's a 93.6% chance that the value of the distributions from that fund today will be maintained over 25 years, and with such a high probability, that does mean that they are likely to grow over time, and that those distributions will be higher in the future than they are today. However, we also know that with the passage of Senate Bill 26 in the 2023 legislative session, that the legislature, or the signature of the governor, intentionally put additional funds into the Severance Tax Permanent Fund for the purpose of increasing the distributions from that fund to offset the long-term decline for oil and gas. So what this number would tell us is we would expect to see a very high intergenerational equity score. That's what we would want to see to show that that goal that the legislature had of increasing those distributions over time with the hope of offsetting the risk of oil and gas decline has a likelihood of being met, and that's a high score. We would want to see that. Now, for a different fund, say, for example, the Opioid Settlement Restricted Fund, you'll notice that that here has a lower score. So it depends on the purpose of these funds, how long they're expected to be maintained, on whether that low score is considered a problematic or not. Now, for the opioid settlement restricted funds specifically, I would point out, if we're on page 137, that score of 17.2 tells us that with no future inflows, that was the base model for that, what that fund has received today has only a 17.2% chance of maintaining its economic value, so therefore likely to decline over time. However, you'll notice in page 137, the middle column, where there's an impact of an up move to the assumption for inflows. Now, some of the details of the opioid settlements are still being hammered out in terms of what dollars are going to be coming in, when they will be deposited, and how long over time. Now, $3 million a year over the next 18 years was the assumption used in LFC's fiscal impact report. And if that did happen to be the case, you'll notice that that moves that score to 53.4. So therefore, maintaining that probability of intergenerational equity and the value of those inflows over time. So again, the score itself doesn't tell you much unless you understand the context, and so it's important that we go through each of those. Another one that I would point out is for early childhood funding. So early childhood is detailed on page 122, and you'll notice that the Early Childhood Education and Care Fund has a score of 65.3%, so likely to not only maintain its economic value, but likely to grow over time. But we do know that the legislature and the executive has a goal of growing and increasing funding for early childhood. Therefore, a higher score may be indicative that this fund will grow that funding over time relative to its benefit now. And we even see that in terms of uses. So we recently did a presentation to the Legislative Economic Study Committee on the funding sources for early childhood. And if we look at fiscal year 23 versus fiscal year 25, in fiscal year 23, distributions from the Early Childhood Education Fund were 6% of the early childhood budget. Now, in fiscal year 25, with the increased distributions, there's a new $250 million minimum from this fund. With that increased distribution, as well as the 60% of the 1.25% additional from the land grant fund, these three sources now make up 58% of the early childhood overall funding budget. So increased importance of this funding source would say that we would probably be looking for a higher intergenerational equity score than just a 50 if the goal is to have these funds continue to increase funding for early childhood. The last couple of things I'll point out is if we're looking on page 123, you'll notice that there are two red lines here, one with the IEI objective as of this year for fiscal year 24, and then the IEI objective for 3 years from now. Now, this is particularly important for a fund like early childhood because the IEI objective for fiscal year 24, the distribution this year was $150 million. So that means what is the likelihood that as of running this model this year, what's the likelihood that we could maintain that $150 million over the course of 25 years? That's a 65% probability. However, there's a new minimum as of next fiscal year, that's $250 million. And even though that's the minimum, within 3 years, once the years of smaller fund balance roll off and we get to a higher fund balance, you'll have a new distribution that you'd want to maintain. And in 3 years, you'll notice that that objective becomes harder to maintain under the baseline scenario. I don't think we had an actual score here in it, but you can see from the red line, the sort of middle red line that's starting in the 3rd year, and that middle blue line no longer keeps up with that objective. So once you have a higher target 3 years from now, that target might be harder to achieve, especially because the Early Childhood Education and Care Fund, most of its inflows have already been received and will be received over the next 2 or 3 years, while oil and gas dollars are above the 5-year average. Once the 5-year average goes up, we don't expect any additional inflows into this fund, absent some crazy windfall oil and gas year. but that current expectation says that without additional funding and a new higher distribution policy in 3 years, once the averages catch up and will distribute more, that might be harder to maintain over time. And again, this is really just to point out that at any single point in time, the score itself doesn't tell you as much as the context around what is going into the fund and what the goals of the fund are. And the last thing that I would point out is for water trust funds. Now this is, again, the first year we've included water trust funds into this analysis, but you'll see that it has a score of 43, so a 43% chance of maintaining its economic value over time. That's a little less than 50%. However, this fund has been on a downward trajectory for a very long time until recently it received some substantial inflow from the legislature, $100 million, and then an additional distribution, which we already received it, so it's not here. Excuse me, I don't remember off the top of my head, but those additional distributions did significantly improve that long-term expectation. So had we run this before, that score for water trust fund would have been very, very, very low. And now it's getting closer to that 50% chance of maintaining its economic value. And again, for something like that, if we're looking at, say, the Workforce Development Fund, now that's a new fund that was created in this last legislative session. We'll be bringing an asset allocation to you soon to approve, so it's not modeled yet without one. But that fund, which has a set funding amount of $30 million, and it makes set dollar distributions that as a percentage of that fund are relatively high, $5 million in the first 2 years, $3 million the next 2 years after, then obviously we would expect to see in an intergenerational equity score that it would not score very high over a 25-year probability of maintaining its value, because more likely than not, with just $30 million and that high of a distribution, that it would not be able to maintain a 25-year runway without additional inflow. So again, it's a tool that you can use to analyze trajectories of funds, but do keep in mind that the score itself does need to be interpreted within context, and always happy to answer any questions that the council has about any specific scores. And I will stop there in the interest of time.
Any comments, questions, suggestions? Do you want to keep running through the funds, or does council members feel like we've got enough information based on the, and I appreciate that, getting all the materials in advance, whether we want to start voting on some of these strategies? I leave it to the members. Any recommendations? Want to finish the report?
I'm okay with where they are.
Okay. Sound good to everyone?
Yeah, I just
All
had a
right, let's,
question, Madam Chair. I just had a question. And so when we talk about, this is really complicated and thorough, so I really appreciate the work that's being done here. But I wanted to know that in order to sort of achieve the intent of the study, which to me is making sure that we really don't eat into the corpus of any of these funds. And by doing so, we would need to at least, at minimum, make a rate of return that keeps up with inflation. Is that what we're trying to do here ultimately? Are we just trying to say that the probability of us being able to get, let's say, a 2% return on water trust fund is X amount? Is that what we're kind of doing? And in a very simplistic way, what do you think, Don?
Madam Chair, Member Tejas, I would say what this study does is help us look at what levers are being pulled and whether action is needed, either on our part or a need to signal action to the legislature and the executive, whether or not what's happening is consistent with their goal. So say at its base level on an intergenerational equity objective, it is to maintain that economic value. As long-term investors, I think we are looking at, can our distributions maintain that value after inflation? And the one lever that we can pull, as you mentioned, is investment return. So if, say, the goal is to maintain that fund over a very long period of time, the other levers that are being pulled are sort of maxed out? Is there something that we need to do in the asset allocation to make changes? Like, for example, for the water trust fund, asset allocations were made a long time ago, changes were made a while ago before those funds got additional inflows in order to try to grow that fund as much as possible so that it could maintain that $4 million a year flat distribution. That was a lever we were able to pull, and an analysis like this would let us know maybe that's something we need to do. However, if we already have a fund in, say, full growth mode and say something like the opioid fund or maybe even the water fund, when we're looking at this analysis, if we as a council have pulled all of our levers in terms of optimal asset allocation, then perhaps this type of study would signal that to the legislature or to the executive that perhaps more funds would be needed if the goal is to maintain it.
Or shifting the goal.
And if the goal is only to have, say, a 10-year fund, then no action is needed. We have a low score, you would expect a low score, nothing else needs to change.
Right. And so, it is based upon the payout. So the rate of return and the distribution payout per generation, but at the same time, you know what I mean? Like if you had a rate of return of, let's just say 7% a few generations ago on a total net asset value of the portfolio of, let's just say $10 billion, that payout's going to be a lot less than 7% on a total portfolio value of $100 billion. So how do you keep those two apples to apples with the scoring?
So I may turn it over to RDK just to make sure that I answer this appropriately, Madam Chair and Member Tejas, but this is looking on entirely a real basis. So we're looking at both the real value of the inflows and the real value of the distribution, and the score is telling you the probability of maintaining that real value, so after inflation plus the 0.5% growth of being able to maintain that. So if I'm understanding your question correctly, it's sort of that assumption is baked into how this is modeled to make sure that with the investment allocation and its assumed return and with the distributions on a real basis, can that be maintained? Is there anything that you all would like to add?
No, I think you answered that well. The one addition, if I'm understanding the question correctly, is that the aspect of if you're overspending and eating into, I think what you termed the corpus, that would accelerate the decline in the distribution amount and the NAV as you described. And conversely, if you're not spending your entire earnings, you're allowing the fund to grow, and that growth will compound even further. So it works in both directions. That's why getting the balance right to not overly restrict spending or spend more, because that does have, in some cases, that compounding effect that magnifies over time. So, but that's all incorporated into the analysis. It's all stochastic. So it has a lot of variability. The assumptions in there, it accounts for all of those variables.
Okay, thank you for that. I think that helps. I'm just gonna have to spend some more time thinking about generationally, the total net asset value of years ago and in future years, and what those distribution rate of return look like, and try to keep some sort of sense of parity between the generations. I think, which for me is the most challenging part of the study. But thanks for that.
Madam Chair.
Go ahead, Member Montoya, go ahead.
I think that this intergenerational status is a good snapshot for us to see if we're parallel or aligning with what, one, the goals were of the legislature and the executive, and then two, that we're making sure that our asset allocation is based on those goals. And if it's not, then it gives us the idea to being able to go back to the legislature and the executive to say, if you're wanting this for this, then this is not what we need to do. We need to either add more money, or you need to recognize that you need to either lower your cost every year or only get a certain portion of your cost. So it's really just a snapshot for us to see if we're aligned, but there's a lot of other variables in 5 years, 10 years, 20 years, including market conditions that will change this. So the snapshot is just good for us to see that we're parallel with the goal. I would say, to Don's point on the fund that just got passed by the legislature, we've all talked about it in SIC, that it was a short-term fund. A lot of times people are saying it's a trust when it's really not a trust, and we're talking to legislative finance council and legislative council services about that. That 30 million is not expected, and mathematically cannot be expected to go out further than the 10 or 15 years, even if you took high risk and even if you had the greatest rate of return, because it's 30 million and they're taking out, I think, 5 million from 2 different sections for the first couple of years. So something like that, to Don's point, we'd go back to the legislature and say, if you're wanting this more long-term, a real trust has to have a lot more money in it in order for us to be able to sustain both the outflows and being able to sustain the rate of return and the inflow. So I appreciate the work that went into this to help us to know whether or not we're paralleling in each one of these portfolios. Thank you.
Yeah, I was just going to echo that. Look, the legislature, to their credit, based on the model for the land grant permanent fund, is setting aside resources, looking at both meeting short-term requirements. So water, we got $1 billion of infrastructure we need minimally. We've got a bunch of it in a variety of places with federal funds and state funds. And if you were to replace every single water system in the state of New Mexico, every single one is failing. There isn't one that isn't leaking or doesn't need to be almost entirely replaced. That includes Santa Fe and Albuquerque. So if we do all of that today, 10 billion, 25, 100, depends on what we find when we start to dig it all up. So we're setting aside money. We know we need some emergency or high priority, emergency is the wrong term, investments immediately. And it'd be nice to know that there's some money available for us to reprioritize and re-leverage federal funds. It's a very interesting sort of chicken and egg. Who's going to go first, and how do we cobble together that money? On the education side, you definitely need to have that scoring so that we've got a snapshot about what education costs are going to look like. They're going to increase. Although there is a new study that says with AI, they will decrease. I mean, there's just no way to really understand that. But part of it is, the goal is to spend money now so we're not spending so much later, because those costs go up, and the human cost to not dealing with our risk issues from education to behavioral health is problematic. And then having money in the out years. So I really appreciate the education for a policymaker. That's me. We don't have the financial expertise that the collective here have, but these scores help the executive branch, the public, and the legislature figure out what percentage of money should we be putting towards later year expenditure availability in all of our priorities. And I think they're doing a pretty effective job at that. And these scores and this conversation, I think, is useful for the public to figure out what it is we're trying to do to make sure that they have as many opportunities for 50 to 100 years as possible in the areas that matter most: water, education, healthcare, conservation, environment, etc. So thank you. Very helpful to me. Any other questions, comments? Okay. Thank you very much for those reports. So ahead of us on item 3, we have 4 votes, one for the private equity, for the New Mexico private equity, for infrastructure, 2 different of our infrastructure funds. So for 3E, it looks like we go to our capital partners. So, and they're coming up now to lead us through those.
Morning.
Morning. So we're just make sure I'm on track. We have several action items now related to the, reports that we've received, and we are gonna initiate that effort now.
Want me to go ahead? All right.
Yep.
Okay. So
Thanks, Chris.
two investments this one, on the private equity side. One, a buyout manager in our national program, Monomoy. Forsyth is here with us, present that. And then a small venture investment in our New Mexico private equity program, that has already made an investment in New Mexico, which I'm excited to tell you about. So on Monomoy, we're recommending a commitment of up to $50 million to Monomoy's fifth fund. Monomoy is a value-oriented middle market buyout fund focused on manufacturing, industrial, and consumer businesses. And this is kind of the core of the asset class at the end of the day. These are generally businesses that have been family-owned, or they're micro-cap public companies or orphan divisions of public companies that kind of need help. They need help with upgrading management, professionalizing their systems, and it's a pretty easier said than done, but it's done well, and Monomoy's done it quite well. Produce outstanding returns. Monomoy is really differentiated in the market. They pay much lower valuations than normal, and given the cost of capital has increased dramatically over the last 4 or 5 years, paying those lower multiples actually allows them, if they improve the businesses, to actually have the potential for some multiple expansion, which is becoming probably less likely for some of the more data-oriented strategies like tech software buyout. We'll pass on to Richard.
Thanks, Chris. Thanks, Madam Chair. Richard Pugmire from Mercer. Monomoy is a new relationship in the national program. As Chris mentioned, the fund is expected to focus on buyout investments in middle market companies in the industrial and consumer sectors. We like several aspects of this fund for the portfolio. First, Monomoy is focused on value-oriented transactions. So what this means is they're looking to acquire companies at lower prices than other companies in the market, usually driven by some type of complexity with the transaction or with the company. But in addition to buying right, the strategy also focuses on growing cash flows and profitability to generate returns. They also execute their strategy using lower levels of leverage than the average buyout. To assist with this, Monomoy has a large operating team to assist with various value creation initiatives at the portfolio company level. From a firm standpoint, Monomoy was founded in 2005 by a team that previously worked together at KPS Capital Partners, which is another relationship in the national program that's been a strong performing relationship. Two of the founders continue to serve as co-CEOs today, and the investment team has 21 professionals in this table over the last decade. Regarding alignment, many of the terms are similar to what you see in similarly sized buyout funds. They also have a large general partner commitment to the fund, which creates good alignment with limited partners. Looking at performance, the firm has generated favorable performance since Fund 2, with above median performance in many measures actually being top quartile. The fund does have a lot of demand, and we're recommending a $50 million commitment to the fund. I'll turn the time over for a presentation with Jamie Forsyth, partner and head of investment team.
Thank you, and thanks for letting me introduce Monomoy to you all. Chris and Richard did a great job, so I'll try and add just a little bit more. I'm Jamie Forsyth. I'm a partner at Monomoy and head of the investment team, and I've been with the firm for 6 years, starting as an analyst and working my way up to partner over the years. I'm joined on the phone somewhere by my colleague Ashley Johansson, who after 10 hours of delays and a canceled flight yesterday could not be here today. She's very bummed to miss it, but here we are. At Monomoy, we are value investors at our core. We've been investing in manufacturing and distribution businesses that serve the industrial and consumer sectors for the better part of 19 years. We think about 2 key tenets in our approach: value investing and value creation. For us, value investing means buying businesses at discounts to market multiples, which has translated to less than 6.5 times unadjusted EBITDA in a market where industrial businesses have traded for about 10 times adjusted EBITDA. It's important for me to emphasize our focus on unadjusted EBITDA because we feel that we have to take an honest assessment of a company's cash flow profile and ability to pay down debt and de-risk our investments early on in our investment history. In terms of the
way that we approach our investing, we take a patient, systematic approach to underwriting and to sourcing. Most of the businesses we buy are out of some type of broken process, as there's a large percentage of transactions in the middle market that actually fail to transact the first time around, and we have a special process that mines for that deal flow. When we think about value creation, we think about our large in-house operating team of 19 professionals, both junior and senior, who really serve as resources to our management teams in terms of executing our value creation plans. We primarily buy family-owned businesses that require a heavy operational lift and lots of professionalization, and so we're able to buy good performing businesses that we can make even better through foundational investments, cash and EBITDA initiatives, and growth planning before ultimately selling them into the sea of buy and build sponsors or logical strategic buyers who maybe didn't want to deal with that heavy lift the first time around. Our operating team is fully integrated with our investment team and is part of the deal team early in diligence and well before we put any capital at risk. The investment and operating teams work together through underwriting, acquisition, ownership, and monetization, and that integration is a real underwriting advantage. The alignment continues when we think about compensation, as the investment and ops teams are both compensated very similarly in terms of base bonus and carry in the funds at the VP level and above. The third differentiator that is really important is our team and our culture. We have a very large team of 72 Monomoyans, all of whom are employees of the firm and not advisors or consultants, and this team spans across investment and ops, business development and IR, finance and compliance, talent, and administration. We have a young and hungry group of folks who've been investing through cycles and are all active in the deal-making process, with Dan and Justin, our co-CEOs, investing together for over 20 years. I've been with the firm for 16 years, and we have a team of 21 investment professionals, 8 of which are deal leads. They've been homegrown through our system, most of them starting their private equity careers at Monomoy. Lots of capacity to deploy capital. So we have a fantastic team. When I look across our full team, I see an institutionalized platform comprised of a lot of homegrown talent on the investment side, with consistency in the team and a great track record, coupled with best-in-class resources on the operating side, with a broad toolkit to effectuate operational improvement and total alignment across the firm, and then full support from our remaining critical functions. When I think about our culture, my 2 favorite values that I think describe us very well are humility and continuous improvement. We love process and systematic execution of our investment philosophy, and we're constantly looking back to make sure that we understand what we did really well and what we need to improve. We learned a lot of lessons in our first fund and applied those lessons to funds 2, 3, and 4. And between that, the way that we source transactions, and the way that we create value with our operating team, we've been able to generate top quartile returns across our last 3 years. Our strategy going forward is to just keep doing what we're doing. Fund 5 will be a larger fund, but we're staying in the same market, and we're doing more deals by ultimately taking advantage of our sourcing system, the team, and the process we established. Thank you for your time.
Thank you. Any other comments based on that? All right.
Provide a motion.
Terrific. John Bingaman, you're up.
Okay, based on the recommendations of the Council Investment Committee, private equity consultant Mercer, SIC staff, and the general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $50 million to Monomoy Capital Partners 5 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, we've got some seconds. All right, will you please call the roll?
Governor Michelle Grisham.
Yes.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Sommer.
Yes.
9 in the affirmative, motion passes.
All right, terrific. Thank you, everyone. next group. Thank you, Chris. Yeah. 100%. Let's take it.
So the next investment,
Thank you, Chris.
is a New Mexico program proposed commitment. We're recommending a commitment of up to $15 million to J2 Ventures Argonne Fund. J2 Ventures is an early stage venture capital firm with a focus on dual-use technologies across 4 areas: advanced computing, cyber, infrastructure on the software and telecommunications side, as well as health technology of interest to the DoD, the Department of Veteran Affairs. When we look for managers in the New Mexico program, we look for, a couple high-level things. Do they invest in areas of sectors that make sense for our New Mexico? And, the 4 sectors we described, all have the potential to be developed in New Mexico. And we look for, is this a group that can help companies expand and grow? And the firm is, the background of the firm team is really uniquely positioned to help companies source and obtain government contracts and provide them with additional runway. They can talk about the background earlier in their careers at the Defense Innovation Unit and other government-related entities. We size the commitments in this program based on the likelihood of New Mexico investments. They hope to make 2 to 3 investments in New Mexico during the life of the fund. They've already made an investment in a company that will be headquartered in New Mexico called SIC-2024.0528, which builds chip-scale atomic clocks, and they can tell you what that actually means. We're going to try something new this meeting. We're actually going to have the founders talk as well about why they chose J2 as a partner and why they chose to headquarter in New Mexico. So that's something new we're trying. J2's leading the company's called Mesa Quantum. They're leading this team. I'll pass it on to Richard.
Chris, I'm sure. J2 Ventures is a new relationship in the New Mexico program, so this is the first commitment that we're making to them. We're recommending a $15 million commitment to their second fund, J2 Ventures Argonne. J2 started in 2020 and was founded by Alexander Harstrick and John Bronson, who are also the managing partners of the firm, and both are here with us today. Both have strong experience from prior roles before J2. Mr. Harstrick has a military background and also worked with various U.S. government investment programs, focusing on both civilian and military technology. And Mr. Bronson has consulting, investment, and startup experience. And they've added 2 partners and a principal to support them on the investment side. Strategy is why we think this is a good fit for the New Mexico program. The fund focuses on early-stage venture capital investments in sectors like advanced computing, cybersecurity, health tech, software, and telecommunications. They do seek companies that have that dual-use technologies that are important to the government from a national security standpoint, but also have civilian applications. One area for sourcing new investments for J2 is the national labs, including those in New Mexico. And as Chris mentioned, they do expect 2 to 3 investments based in New Mexico and have 1 company already in New Mexico, which you'll hear more about later. As part of their strategy, too, they also focus on government programs to help companies obtain grants and other non-dilutive financing. They've been successful doing this with the portfolio companies that we've talked to in the due diligence process. From a track record perspective, J2 doesn't have a long track record, but their first fund is performing in the top quartile. We also looked at both of the founders' prior track record and found favorable performance across several companies, generating favorable returns. You look at fund terms, they are typical for what we see on other early-stage venture capital funds regarding management fee and carried interest. We're excited to have the 2 managing partners of J2 here, and we'll turn it over to them.
Thank you all so much for having us, and Governor Grisham, it's an honor to meet you. Thank you so much for hosting. My name is Alexander Harstrick. I am one of 2 founding members of J2 Ventures. I was told to keep it short and sweet, but I will make the joke that I am the more voluble of the 2 of us, so I often do most of the talking. I'm glad that one landed, thank you. By background, John and I actually met at Columbia when I was an undergrad, and John was a PhD student. I was a venture capitalist after that, the track record, which is was alluded to before, predominantly in healthcare. I had this money isn't everything realization, and I enlisted in the U.S. Army Reserves, commissioned through Officer Candidate School, and then served with a Special Operations Joint Task Force in Afghanistan and Iraq, among other areas. Thank you, ma'am. I'm actually still in the reserves, in a facility that does not take me away from my day-to-day work here, but it does feel very important to remain in service in that capacity. I went to, after serving overseas, I worked at the Defense Innovation Unit underneath the Secretary of Defense, Ash Carter, and then in other capacities, predominantly among something called National Security Innovation Capital, which worked directly with national labs and other areas, actually within the middle of the United States in particular, looking for deep technology that would make the U.S. competitive against Russia and China, and then did additional duties for the Air Force's strategic investment arm called AFWorks. I did this while going to business school at Harvard Business School, where in my capacity there, I worked for General Dave Petraeus at KKR, incubating a thesis not dissimilar to J2, but for legal purposes, dissimilar from J2. We were approached by a family office shortly after that. John was down the street, and that's how we began our start. Very small beginnings, as a series of SPVs. We raised our first fund in 2021. We intended to raise $50 million. We raised 70. And this fund, we intended to raise $120 million. We have raised, depending on New Mexico's commitment, 150, which will be our hard cap. And New Mexico is our last commitment, which feels very strong to us. The name Argonne for the fund is actually a DoD national lab, and we'll go down all the way through the list. So Lord willing, we'll grow with you, and we'll be there for Sandia, and we can all reference this conversation.
In my background, not military, all science and technology. So I have a PhD in computational chemistry, a lot of artificial intelligence, machine learning work there. Then spent a couple years at the Boston Consulting Group doing healthcare, financial services, and industrials. I left for a chance to form a healthcare startup with two former chairmen of the Crohn's and Colitis Foundation. We're helping patients with chronic diseases visualize medical records better. And after that was acquired, I worked at a large hedge fund in New York called D.E. Shaw and did a mixture of risk management there and renewable energy project finance. So building, buying, owning, operating solar and wind throughout the United States. I did about $750 million of debt and equity transactions and really saw how investment at the federal and state level completely transformed that industry. And we saw a lot of parallels between what was going on there and what was going on with the Defense Innovation Unit and Air Force Ventures and programs like the SIC here, trying to create innovation and venture. And so from my perspective, that's why we started the fund, and it's been performing very well. We talked about the areas that we invest in, and always very focused on this public-private partnership and really trying to channel that to find these unmet national security needs. So New Mexico, from our perspective, is really an ideal location. Sandia, Los Alamos, truly unique. What this area is doing with respect to quantum and infrastructure and energy in particular are really powerful. And we'd love to tell you about Magic Quantum, which would not exist without Sandia National Labs. So we thought maybe it would make sense to let the founders talk about it directly. Is there anything that you wanted us to address before we turn that over?
As we're transitioning to that, I am actually very sad to miss this presentation. Wayne Props, the Secretary of the Department of Finance, will finish up chairing the meeting. This is my first day back after a lengthy economic development trip. So that was my note, get out and do other work. But I will catch up, and it's nice to meet you all, and thank you for presenting to this very effective and esteemed group.
Thank you very much.
You're in great hands. Everyone stay seated. We're good. Go ahead.
Mind introducing them?
Yeah, absolutely. So, while Governor Grisham exits, it's a force of habit to stand whenever this so we're joined by Wale Lowell and Cersei Agarwal. To give a quick background, Wale is a fellow veteran, albeit in the Air Force. Not everyone could figure out where the Army recruiting stations are. U.S. Air Force grad. who served for 4 years as a scientist, predominantly in material science development. He received his PhD in material science from Rice University, and then went to get his MBA and MS from Harvard Business School. Srishti, I don't give your background as much justice, and you're the CEO, so I figured this was actually a good time for me to hand it over to you for your intro, if you don't mind, and then the broader introduction to Mesa Quantum.
Yes, thank you, Alex, and we're really excited to be speaking to you all today. So my technical background is in quantum. I did my undergrad in India, then spent some time doing research in Japan on quantum measurements, then worked a bit in Europe, in France, on quantum computing and cryptography before moving to the US, where I did my PhD working at the national lab, which is NIST, Angela. And my PhD was around quantum information and computing. And that's what got me excited about the possibilities of the real world application of quantum sensors and led me to go found Mesa Quantum. I have previously helped found a technical startup and founded 2 nonprofits in India. And so that's kind of my brief background. I can talk a little bit about what we're doing at Mesa Quantum. Here we are developing chip-scale quantum sensors, starting with next-generation chip-scale atomic clocks. And the goal with these sensors are to provide resilience against GPS outages, which would be a critical part of what enables development of secure communication, autonomous vehicles that we hear so much about, and modern renewable energy grid systems. I will not bore you with more technical details, and I'll hand over to Wale to just talk a little bit more about our engagement with J2 and why what is our next steps.
Yeah, thanks for the handover there, Srishti. Pleasure to meet everybody. Thank you for giving us the time to talk. Again, I am Wale Lawal, proud member of the Air Force, the finest DoD institution you can imagine. Alex mentioned, came through the Air Force, through the Air Force Academy, where I actually majored in a technical major, material science, in which they actually gave me and afforded the opportunity to do that PhD, focus on nanomaterials and quantum materials for DoD applications. So quite relevant to the topics here today. And I spent the majority of my career in the Air Force Research Lab, commercializing a variety of different technology sectors. And so that got me quite excited about continuing building technology after we got out, after I separated from the military. And as I was completing my MBA from Harvard, one of my classmates actually connected me with Srishti, who was absolutely crushing it with this startup called Mesa Quantum, was very excited about commercializing the IP out of the lab. And at the time that me and Srishti connected, I was putting together dual use technology workshops out of MIT, and ended up getting connected with J2, who's very plugged into that ecosystem. And so through working with them, put on a very robust dual use course through that came across MIT, Harvard, the broader ecosystem like MIT, Lincoln Labs, and Draper Labs were all participated in the program. And so that was my first understanding of the relevance of somebody like J2, who doesn't just have connections to startups and invest, but also builds the ecosystem of dual use ventures. And so I got very excited to continue conversations with them, told them a little bit about what me and Srishti were doing. They understood exactly the need to leverage non-dilutive capital combined with dilutive capital, investor capital, and the relations that come with that to really build these emerging complex technology like quantum sensors. So immediately I knew they were a great fit for us. Glad we were able to get them as our lead investor. And that, again, also spurred a lot of interest and discussions around New Mexico as an opportunity, which we weren't exactly looking into until we heard of this from J2. And maybe I'll let Srishti talk a little bit more about how we're engaging with New Mexico right now, thanks to some of the work with J2.
Yeah, thank you, Wale. And we're really excited about moving to New Mexico for several reasons. Firstly, as they mentioned, the incredible research happening at Sandia in the field of quantum sensing. Sandia has been funded through multiple DARPA programs on development of chip-scale quantum sensors. When we connected to them, we realized the potential of close collaboration with Sandia to bring the most cutting edge of quantum sensing technology to the market. And we're now working with them to validate some of our in-house IP developments and explore joint developments for further IP. And secondly, J2 made us aware of the enormous non-dilutive capital support and interest from the state of New Mexico to commercialize emerging technologies like quantum sensors. And we are also at Mesa Quantum one of the sponsors of Elevate Quantum Initiative, which is a federal initiative that aims to establish New Mexico, Colorado, and Wyoming as a quantum hub for the country, and would lead to significant development of the quantum ecosystem in New Mexico, which we are very excited to be one of the early part of and facilitate and benefit from its growth.
So we have been looking at the space for 3 years before we made this investment. Just about every other quantum sensing company or chip scale company that you can imagine, I'm happy to walk you through, maybe not in public discourse, why we chose not to pursue that company. But in this case, in addition to being both a fantastic team, they are the closest to commercialization of this technology, and we feel very strongly that being able to grow this within New Mexico will be a flagship deal that we're all going to be extremely proud of. I should also caveat that Wale is about 6'10", played D1 football, and was a boxer, so it is only when we have 3,000 miles of distance between us that I'm so cavalier. Yeah, I'll leave it there.
Thank you very much for being willing to join the meeting today. Learning more about the company. Thank you very much. And then maybe just in terms of other plans for New Mexico, discuss, obviously made this investment, but what are your other plans for, working with you?
So we've discussed 3. One is I'm very close with, if you've ever been to Sandia National Labs, the Los Alamos National Labs, and any kind of optics center, most of the casings that you'll see were from a company called Thor Labs. It happens that the first investment job I ever received, I sat next to a woman named Jennifer Cable, the daughter of Alex Cable, who recently handed over the reins of the company to his daughter. Jennifer is now the president and functionally the head of Thor Labs. We are going to host 2 events per year with Thor Labs, where we'll bring in academic institutions and other local funds that will help understand all the equipment available and whatever else it is that would be germane in those presentations on a biannual basis. The second piece is, I do think in this space we have a sizable advantage as both being a first mover and directly an architect of some of these programs that will be, again, germane for those who are pursuing non-dilutive financing through the Department of Defense, where we can open up all of our resources, which I think in your investment deck, you'll see some cute pictures of me on CNBC, in addition to other places where I managed to use one word incorrectly when I meant to use another. And in the course of that, sorry, that was also a joke. And in the course of that, be able to leverage that expertise. The third is, as a part of J2, we do have a lot of connectivity within academic centers of any kind of center of excellence related to the 4 areas that we invest. We hosted the author of Chip War. We hosted the author of the Power Law, Sebastian Mallaby, on July 11th in a meeting which hopefully you all will attend. We'll host the author of another book called The Code, written by a woman named Margaret O'Mara, who's a historian that is an expert on this field, a bunch of others that I won't want to sort of tease you with. That's not our annual meeting. That's our quarterly meeting. We host those quarterly. We open up all of those resources to all of our LPs. This is just how we report on a quarterly basis, in addition to, I think, having a pretty cool annual meeting, which we'll host in Tampa, Florida.
Mr. Chairman,
Yes,
is it appropriate to ask a question at this point?
please do.
Thank you for your presentation. I just wanted to clarify one thing in my head. The net IRR for this fund is about 25 to 30%, and the previous fund was over 200%. Is that correct?
So the minimum target that we expect to hit would be 25 to 30, but we certainly hope and expect to do better than that. And the performance of our previous fund is significantly better than that. So we fully expect that to continue to be true, but we'd rather, under-promise and over-deliver.
This fund
That reflects
seems
early write-ups and unrealized companies, just to be clear. So there's a long path between here and there in the venture world. So J2 is a very early stage fund. So while some of the companies they've invested in have shown progress and been able to raise later rounds that have increased the valuations of the companies, this journey is roughly 10-year journey, probably plus or minus, from the inception of the company to having actual liquidity. So just take that into account. It's a good positive sign, but there's a lot of time between here and there.
Thank you for that. I really appreciate that. The last question I have is based on what you've seen in Fund 1 and the comment in one of the presentation pages. Are you planning on getting any full-time back office professionals, or what is your take on the idea of having in-house staff instead of outsourced?
So we have an outsourced back office called the Bureau Advisors that has been absolutely phenomenal. They come highly recommended by several other funds and several other LPs. We also have a fractional CFO who I expect we will onboard full-time as we continue to grow.
Thank you. Thank you, Chairman.
Chris, anything else? Okay. I think we're ready for a motion.
Sure, thanks. Based on the recommendations of the Council Investment Committee, Private Equity Consultant Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $15 million to J2 Ventures Argonne Fund LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Nick.
I have a motion by Member Bingaman, a second by Member Tejas. Any further discussion? Would you call the roll?
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
CFA Secretary Wayne Probst,
Yes.
Nick Tejas,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
State in the affirmative, motion passes.
Thank you all for your time today and for your investment in New Mexico. We appreciate it.
Thank you very much.
Thank you for your presentation.
Thank you very much.
Thanks.
Okay, moving along, item
Thank you.
3G.
Sure.
This is also an action item. Anson Infrastructure Fund 5. Keith, are you kicking us off?
Mr. Chair, if you would grant me 30 seconds to make a quick introduction. I'm pleased to announce that we've recently been able to onboard a talented New Mexican to join the real estate and real assets team. I'm pleased to welcome Juan Treviso. Juan, if you would please stand up. Juan is married with 2 college-age kids. One is a recent high school grad. Both will be attending NMSU in the fall. Juan comes to SIC with joint master's degrees in economics and finance.
Thank you for that introduction, Keith. Honored to be part of this meeting. Looking forward to teach you all. Add some value or way, shape, or form.
Welcome. John, just want to make sure we're keeping that U&M, New Mexico State equilibrium there, so please. Try not to make sure that we have more than one of the others. Fair enough.
So I'm going to lead off with a couple of brief introductory comments. We're bringing 2 infrastructure investments of pretty substantial size today. We are looking at a circumstance where with both of these approved on a fully committed basis, we'll be slightly above the 50% threshold in the portfolio. If you look at a fully deployed portfolio where all of our capital is allocated, there's significant breathing room. That figure would come out to about 44% currently. But just wanted to make sure that everyone is fully aware of that. Joining me today to present Anson Infrastructure Fund 5 is Amy Ridge from Mercer, rather. Kevin Genieser, Managing Partner from the New York office at Anson, and Steve Kennedy, the Director of Investor Relations. To jump right into the fund, we're recommending a recommendation, or an allocation rather, of up to 220 million euros into Anson Infrastructure Fund 5. Hanson's a leading European-based infrastructure manager. They currently manage approximately $20 billion in infrastructure assets across the globe, primarily in Europe. The fund strategy is large cap value add and targets mid-teen gross returns. About 85% of investments will be brownfield, so consistent with the value add profile broadly. This is a diversified infrastructure strategy. They'll be exposed across energy and environment sector, telecom, transportation, and social. A couple of key things that we like about the manager. This is a unique situation in the infrastructure space. Hanson has a definition they call the Hanson Infrastructure Test. It's focused on entities that provide essential business services, barriers to entry, stable, predictable cash flows, inflation linkages in the businesses they would invest in, demonstrated downside protection. This is a somewhat more flexible definition of infrastructure that captures most of the traditional infrastructure investing space, but does allow for some low asset intensity businesses that provide services that might be described or represented by the category social infrastructure. Because of the difference in definition, we expect that this will be a strategy that will contribute diversification to our overall portfolio. With that, I'll wrap up. Forward to Amy.
Great, thank you, and good morning to everyone. Mercer's report starts on page 240. So Onsen will be a new manager in your infrastructure portfolio. They are a long tenured manager. Mercer has actually underwritten them since their very first fund, which was in 2008. So we know them well. We have watched the growth of the firm and continue to be impressed with them. So we think it's a strong add for your infrastructure portfolio. They do have a long tenured team, over 70 people at the firm today. And they also have a performance improvement team, which we like to see, a team that's dedicated to the operational improvement and growth of the assets that the fund will be invested in. One of the things we did spend some time on, there has been rapid growth at the firm over the past 4 to 5 years. They've essentially doubled their team. So we spent a lot of time and we got comfortable there. A lot of that growth is they opened a New York office, which is good because North America is a part of their investment focus. So we like that they actually have boots on the ground that can actually be here investing in one of the regions for the fund. They opened that office in 2019. It's now about 35 people. So we got comfortable with their management of the expansion of the team. There will be a diversified portfolio. 10 to 12 investments are being targeted, and they seek to build value both organically and through add-on acquisitions. They will have an expanded North America focus. It will be up to about 40% of the fund. That is another thing we spent a lot of time on because that is a larger allocation than in the previous funds. Again, we got comfortable with that North America office. They also have a global investment committee. So the investments have to compete against each other, and only the best of the best win, no matter where they are. So we like that overall process of decision making. Terms are generally in line with other infrastructure funds. You will be receiving a management fee discount, which actually brings your management fee below market, so lower than you would see elsewhere. So that is a positive. And lastly, performance. You'll see on page 248 and 249 our performance assessments. They have a 16-year track record. They have 4 funds that have executed the same exact strategy, a very low loss ratio, only 1 realized loss, so below 1%, which is really important in this. And the 3 most mature funds are generating first and second quartile by all 3 metrics that we measure, which is IRR, multiple, and DTI, which is the actual distributions that we're getting back. So with that, I will turn over to Kevin and Keith.
Great. Well, good morning. Thank you for your time today. We appreciate the opportunity to get a chance to talk about Hanson Infrastructure Partners. Again, my name is Kevin Genieser. I'm a managing partner to sit on the firm's executive committee and on our investment committee. I'm joined by Steve Kennedy, who's the director of our investor relations team. I'll try not to be repetitive by some of these comments already made. We were founded over 17 years ago, and our original co-founders still guide the firm. We have a very stable team, and we're very focused on internal governance, both within our firm itself and within our portfolio companies. We're also very proud of the diversity we have established in the team. We have a team actually now up to 220 professionals represented by 35 different nationalities. Very pleased to note that women make up 45% of our workforce and our executive committee, and 40% of our executive committee. As you already heard, our investment focus is value-added infrastructure opportunities in Europe and in North America. We have been seeing strong and consistent performance through the very varied and challenging times we've seen over the last 17 years. And we've also gone through investment cycles fully. So we've fully exited Fund 1. We're almost fully out of Fund 2. We are exiting Fund 3. So our clear track record is really backed up by 50% of our investments being fully realized. So we've seen it all the way through the investment cycle. You've already heard quite a bit about the Anton infrastructure test. Every deal that we do has to meet that 5-part criteria. Is it an essential service? Do we have some visibility on the cash flows? Are there some barriers to entry? Is there some inflation linkage? And is there some downside protection? We think this gives a good combination of both downside risk protection as well as focusing on upside potential. That infra test really is our guiding compass and make sure that we don't have any investment drift as we do various investments both in Europe and in North America. It does also provide some flexibility, as you've heard, so we can think about sectors that are maybe a bit more niche, or maybe aren't quite considered infrastructure today, but we think under our ownership it becomes infrastructure, and that provides more differentiated exposures and a portfolio diversification. I should note we do have one project already here in New Mexico. That's through our portfolio company, Orgis, and it's a project called Project Escalante in McKinley County, which is a $300 million project, which is providing clean power to over 60,000 homes in New Mexico and create over 300 jobs. In addition to the Anton infrastructure test I just walked you through, all of our investments must be in growth sectors, and what we consider to be growth sectors. We spend quite a bit of time thinking about individual sectors, what are the mega trends behind it, do they have good tailwinds that will sustain it, not only at the time we make the investment, but throughout our whole period. We also look for opportunities where we think we can add real value, whether that be through organic change within the business or through some add-on acquisition. That's a pretty abbreviated overview of who we are, and I really appreciate the time you've given us today and considering a partnership with us, and I'm happy to answer any questions.
Mr. Chairman?
Treasurer Montoya.
I know that we're a little bit rushed, but I am so excited about this fund in so many different levels. I went to the investment committee meeting, and I just wanted to let you guys know I appreciate the relationship that you're going to have with SIC as far as performance, check mark, cost, check mark, investment in New Mexico, check mark. And then when you go to page 234, 235, if you look at the picture of their team, and he made a point of stating some of it, but 42% of women, 30-some countries represented, 23% of women in the investment team on the top leadership. And they're planning on increasing 20% share of women and minorities in management positions during ownership. I'm just really excited about you all. I know that these type of funds exist, but I'm happy that you are here with SIC, and SIC staff is working with you. Amy gave a really great presentation the other day on this one and the next one. So I just wanted to say thank you, and I'm grateful, and I'm so excited to second John's motion.
Thank you.
Thank you, Treasurer Montoya. Never too rushed to be excited about a good investment.
That's all I'm asking. Based on the recommendations of the Council Investment Committee, Real Assets Consultant Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to €220 million to Anton Infrastructure Fund 5 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second the motion.
Member Member Bingaman and a second by Treasurer Montoya. Any further discussion? I have one question. How much is 220 million euro?
About 1.1 right now, so.
Okay, I think we're ready for a vote, Brent.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
CFA Secretary Wayne Probst,
Yes.
Nick Tejas,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell, Alan
Yes.
Sanchez, and Kurt Summer.
Yes.
That's 8 in the affirmative. Motion passes.
Thank you all for coming.
Thank you.
Okay, item 3, H, Keith, Guardian Infrastructure Fund 6.
Mr. Chair, we're here to recommend a commitment of up to $250 million to Ardian Infrastructure Fund 6, and this, again, will be a new relationship for the SIC. Joining me from the CP, we'll have Doug Miller, Managing Director of Investor Relations, and Juan Angodia, Co-Head of Infrastructure in Europe. Ardian was founded in 1996, spun out of AXA Group in 2013. The fund is known for its strong commitment to sustainable investment solutions. Strategy, broadly speaking, is a large cap core plus value add strategy and targets low to mid-teens net returns. Again, this will be a diversified exposure across several infrastructure sectors, including digital, transportation, and energy. Ardian's flagship infrastructure funds have generated strong performance over the firm's history, and particularly with respect to their risk profile, and each fund has surpassed initial return targets. What we like about the strategy from a real high level, the portfolio is engineered for resilience. More than 85% of revenues are directly indexed to inflation. More than 70% are regulated or contracted, and the assets are typically brownfield cash flowing assets, and so that mitigates the risk of investing in these types of investments. Sustainability considerations are an integral part of their value creation process, and they have a team dedicated to those activities. Exits regularly occur at material premiums to prior year NAVs, and this tends to be indicative of a conservative valuation approach. And then finally, at least 80% of the capital will be deployed in Europe, so this will be a diversifying strategy for the SIC. And with that, I'll hand it over to Amy for.
Our report starts on page 278. So Ardian, another new manager we would like to add to your infrastructure portfolio. They focus on energy, primarily renewables, transportation, digital infrastructure. So we think those sectors will be a good add and diversifier for your overall portfolio. Primarily focused in Europe, secondary focus in North America. So similar to Austin that we just presented. Ardian has a very long history. They date back to 1996, and they launched their infrastructure strategy in 2005. So again, another cycle tested. They have been doing this for a very long time. And today they have an investment team that is split between Europe and North America. So again, boots on the ground in each of the regions that this fund will be investing in. They're seeking to make 8 to 12 investments focused on purchasing existing assets that are already cash flowing. So that helps with the de-risking profile of the assets they're focused on. And they mainly are going to focus on building value through operational improvements, different growth initiatives, and add-on acquisitions. They're very focused, as Keith said, I would just double down on transforming assets into energy transition leaders. That is all over their materials. So that means that sustainability metrics and considerations are integrated throughout the investment process. Terms, again, generally in line with what we see, but you will, at the $250 million size, be receiving a management fee discount. So you actually have another one where it's below market or lower than market management fees with the size that you will be investing. And the track record's been consistent. Page 288 shows our track record analysis, largely above median returns across their 5 funds. Very low loss ratio with only 1 realized loss to date. So we are recommending up to $250 million commitment, and I will turn it over to the Ardian team.
Thank you, Amy. My name is Doug Miller. I'm Managing Director of Investor Relations here at Ardian. On behalf of the entire firm, we just really appreciate this opportunity to talk more about our infrastructure business and have this opportunity to partner with SIC. Joined this morning by Juan and Goitia. Hold a little exchange on you there. Juan was available to come over, so we're thrilled to have Juan as the co-head of Europe join us for this discussion. We'll jump into some details around infrastructure here momentarily. Just a few words on the firm, as was already well covered by Keith and Amy in your materials, I'm sure. But yes, Ardian dates back to 1996. We began as a part of AXA, and we're known as AXA Private Equity for quite some time, originally as a private equity buyout firm. Long story short, the firm continued along that path until the mid-2000s, when we launched the infrastructure business, as Amy just referenced, as well as other parts of our platform, including credit. You can see how the assets break down on our overview slide. Slide that is in your materials. But at the end of the day, we're a large private markets investment house based in Paris, France, as we have been throughout. Really independent is a key element in our ownership situation. Employee-owned, which I think is a key element of who we are as a firm. At the end of the day, the investment platform is rather diversified, but we're here to talk about infrastructure, so let's get into it. The fund that we're on at this point is our flagship infrastructure fund number 6, and let's get right into that. As already mentioned, Ardian is one of the pioneers of infrastructure investing. We have about $31 or so billion across the platform under management. With that, I'm going to hand over to my colleague Juan.
Well, thank you, Doug, and thank you for having us here today and this fantastic opportunity for us. In terms of the strategy, I mean, what is the strategy that we like to have been deploying since inception back in 2005? I mean, we like to provide, or the goal is to provide the clients investment portfolio, access to the investment portfolio, providing resilience, inflation protection, and also career performance. And how do we do it? The way we do it is by investing in what we call essential infrastructure. And what is that? For us, that is toll roads, transportation, energy, utilities, and digital. And we have been doing the same since the beginning. Our first investment back in 2005 was a stake in a network of toll roads in France. At that time, we were very little. We only had money to take a 10% stake behind one of the largest operators in the world. Today, we would be doing the same investment, yes, but rather than holding a 10% stake, we would be holding a controlling stake. We have grown. Today, we are 17, plus 30 operating partners, plus all the support functions, and we have the skills and the knowledge and the house have evolved as well, and we are ready to do that. So investing in essential infrastructure, capital intensive. So CapEx, capital intensity, investing in real assets you can touch, that is what we like. And that CapEx, that's the value creation. On one hand, it provides a lot of protection. It provides long-term visibility of the cash flows, barriers to entry, and characteristics of infrastructure. And at the same time, it gives us the opportunity to continue growing and expanding and creating value. Because that CapEx is crystallizing into revenues and EBITDA. And that is very important for us. For the management team, that growth, in that journey, transforming the portfolio company. The one thing that we also like is to, I mean, I would say the two things that we also like to have in our kit are everything related with decarbonization or ESG sustainability. You can use the word you want, but at the end of the day, that is critical.
infrastructure, I'm not going to discover anything here, but today, I mean, we came here by road, and 100 years ago, 200 years ago, when the road was not there, there were trees, and there was something. So infrastructure by definition is very aggressive with the environment. What we like to do is, on one hand, the environmental risks that we have during due diligence, we like to basically mitigate all those risks, so they don't crystallize into liabilities. At the same time, we like to contribute as much as we can in the sustainability. So environmentally, decarbonization and transition is really in our DNA. We like to set the CEOs of our portfolio companies targets of reducing CO2 emissions and reducing energy consumption, and those targets flow down the organization. So there are real money on the table, so performance is subject to that. And at the same time, you know, we like to contribute that. I mean, so that is clearly one of the key areas that we like. On continuing and thinking with the ESG topic, I mean, social infrastructure, or the social element is also very important for the infrastructure. Infrastructure as a part of the community. They have to be aligned with the targets of the community. Therefore, we have to push in the same direction of the community, otherwise. So that is the other key element. The other tool that we have is digitalization. We have 4 data scientists. We have 60 portfolio companies. We collect all the data from the portfolio companies. We cluster the portfolio companies, and these 4 people, they analyze the data. They help the management teams to analyze the data and to come to really interesting conclusions. So that is, you know, spreading the assets, the existing assets, the best way to be sustainable. I mean, continuing with the example of Atollo. Funding Atollo is very easy, just read another lane. Again, super aggressive with the environment. Whereas playing with dynamic tolling, for instance, to incentivize or manage the demand, that today with the hardware and the software that we have available, we can do it. So that is also the way that we like to be sustainable. And just to finish before getting into the performances, I mean, we believe that this investment cycle is a lot of CapEx needs in the 3 verticals that we invest: transportation, energy, and digital. I'm talking about Europe, mainly. And here we can see that, you know, the industrials, they have a lot of debt. They will not be able to do the investment. Governments, a lot of debt. They will not be able to do the investment. So we, as private sector, we like to fill that gap and be part of that evolution. This is all translated in the performances. I will not repeat the performances that were mentioned before, but I think that's important. Diversification is also critical. So building a diversified portfolio by asset class, by country, by type of revenues, contracted, regulated, or GDP or volume risk, and also by the size of the company. We invest in super large companies. We are the largest shareholder in the 4th largest utility in Germany, or it's in the press that we are going to become the largest shareholder of Heathrow Airport, the 4th largest airport in the world. Whereas at the same time, we have invested very recently in a startup company building data centers. So this diversification also provides protection. And in today's world, where you have a lot of volatility, the best way to protect against that is diversity. And on that, we have a CIO, Marion Calcin. She joined us as an intern back in 2005. Today is our CIO, and basically she's doing an instrumental work. And then just to finish, a few words on the team. A lot of stability on the team. We are essentially for 70 people in the team. We have also a number of operating partners, more than 30, helping us. And the team, we have been very stable. We only had 1 senior people leaving the team back in December 2020 because he decided to have a more entrepreneurial role. But the team, we have been working together for many years. Very stable team and local. I mean, people were mentioning before that we have boots on the ground in the Americas and in Europe. In Europe, you drive 500 kilometers and you're in a different country, different language, different culture. I'm Spanish. I can go to Germany. I can do a bit in Germany. I will miss things. It's I don't speak German, and I don't understand the German culture. Whereas in Spain, I'm local, I know the people there, the culture, and I will not miss. So I think that local element is critical. Also, when it comes to the execution of the transactions and holding the investment, these investments are essential infrastructure. And the government and the administrations, they like to know who are the shareholders. So having the track record and the, the being, let's say, good citizens in these countries, it helps a lot in the execution. So that is also a key element. So I think with this, again, I think we have to talk to hear our presentation. Thank you very much for the time, and happy to answer any questions.
Thank you, and welcome to Santa Fe. Appreciate you being here. Keith, anything else?
Nothing further.
John, would you like to
Your Chairman?
make a motion? Treasurer Montoya?
I just had one question. I appreciated on staff side looking at the diversity. It's also definitely in this one. I don't know something about greenfield investments. And it says that there's 15% commitment that may be allocated to greenfield investments. And there was a mention of JV with 5T hydrogen to create HY24. I don't need a long synopsis, but if I can just get a little bit of insight of what all that means.
Yes, I mean, we like to invest in companies which are already in operation or have a base of cash flows or activity which we can grow and move forward. The one you are referring to about hydrogen, I mean, hydrogen is going to be part of it is part of the energy transition. And back in, I think it was 2 years ago, we decided that for this flagship fund and investment in hydrogen doesn't really fit well. So it's a different risk profile, and therefore we decided to launch a specific initiative for hydrogen. And there what we did is we are teaming up with 5T. 5T is the former Air Liquide hydrogen team. So Ardian, we hold 51% of that, or 50.01, and then the Air Liquide team holds 49.9. And we are channeling all the hydrogen investments through that particular vehicle and fund. Because risk profile, again, that doesn't fit what we are basically explaining here in the strategy that they are.
Thank you, Chairman.
Madam Treasurer, this is Keith Sable speaking. Did that address your question sufficiently, or would you like an explanation of the greenfield versus brownfield?
No, I'll visit with you offsite, just for nerding out more information later, but I got enough to at least make a decision today. Thank you.
Thank you.
Thank you, Treasurer Montoya. Tom?
Sure. Based on the recommendations of the Council Investment Committee, Real Assets Consultant Mercer, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $250 million to Ardian Infrastructure Fund 6 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. Okay. We have a proper motion by Member Bingaman and a second by Member Sommer. Any further discussion, questions, comments? Brett?
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Lauren Montoya,
Yes.
CFA Secretary Wayne Probst,
Yes.
Nick Tejas,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
8 in the affirmative, motion passes.
Thank you very much. We appreciate it.
Thank you.
That concludes our investment matters for the day. Take a moment to thank Member Bingaman and the Investment Committee and the investment staff for all the hard work that goes into each and every one of these recommendations. I also want to thank our consultants who every month month come to Santa Fe. We know a night in Santa Fe is exactly a hardship, duty, but we do appreciate all the work that you do with our staff and your being here on a monthly basis. It's always good to see your familiar faces. It develops a lot of confidence for the council. We do appreciate that as well. So, move on to financial matters. Brent, you want to kick us off with the CFO report?
Sure. And I'll be brief. Just want to touch upon 3 items primarily. On page 314, we have a budget summary for the fiscal year. I just wanted to point out this is through the end of April. We just, I think as of last week, toward the end of last week, finished paying the management fee invoices for the third quarter of the fiscal year, which means probably over the next week or so, I'll be going in and doing some purchase order adjustments to get us through the end of the fiscal year. So as far as the summary is concerned, you see the big savings in that last column. I would expect that to drop off probably by about half that, given PO adjustments that we have pending. And then lastly, or second to last, I just wanted to point out on page 329, there was quite a bit of discussion at the CIC about clients, and I just wanted to point out as part of the investment holdings report for the month of April, there is a schedule here, just like you have a schedule for all the individual permanent funds. You have one here for clients, shows $2.122 billion as of the end of the month. If you turn over one page, and I realize this is a little small, you can see the individual clients as well as their particular slice of the permanent funds that are over or at the top of the schedule. So if you want to pick any client that we have, you can see at any month end that you have this investment holdings report exactly how they're allocated to the individual pools. We have 21 pools. The clients aren't invested in all of them, but the ones that they are invested in, you can see on this schedule. I don't know, Charlie, if you wanted to add anything to that, but the way to look at the pools, and people always ask about this, I look at the pools as kind of pizza pies, and the permanent funds and the clients have the pieces of the pies, and the permanent funds by far have the much bigger slices. The clients are only about 5, 6, 7% of the total investments that we have. So just realize their slices of the individual pools, depending upon the pools. There's some pools that are more directed at the client, so they might make up a bigger part of it. But generally, most of the pools that we have, the client slices of those pools are going to be quite small based upon their size to the total assets that we have. And then lastly, I just wanted to point out for this meeting, we do have a motion pending. I just wanted to give a little bit of history on the RFP. We issued an RFP in the middle to later part of April, got responses in earlier part of May. We are approaching the end of the fiscal year, so we had to kind of rush to get this done. But we did issue the RFP, had 3 responses. The responses were graded by 3 people, myself and 2 members of the council. And the total scores that we had has Moss Adams, who's our current auditor, the winner of the most points for this RFP, and it's only for 2 years, this year and 1 other. And I'm open to any questions on the RFP or anything else that you might have in the financial material.
Thank you, Brent. Do we have any questions on either the CFO report or the External Audit Services RFP? Nick, did you have anything else to add on the RFP?
No, we went through the whole entire process in the audit committee, and the audit committee members participated, and so according to plan, and we've arrived at the current award to the current vendor. So I think we're in really good shape. I think, Brent, the 2 years is just a limitation on the audit rule, right? We can only do.
Member Tess, I'm glad you point that out. We think we have 2 years left. It would take us to 8. I would point out, I think it's tomorrow, I'm going to be attending a rules hearing by the Office of the State Auditor. It could be very well the case that this last year, for some reason or another, that's next year's audit. We might very well have to go out to bid for that, depending upon how the audit rules are approved this year. But currently, we do think that, assuming that the motion passes, that we would be okay for this year's audit and next year's audit, barring no further changes by the Office of the State Auditor.
Anything else from Treasurer Montoya?
How many different agencies or entities were in the RFP process? I didn't see any paperwork in our packet, so I was just trying to get sort of a rundown. And then is the cost the same as the previous, or what is the cost now? And what will be the cost for next year or any renewals?
Treasurer Montoya, I'm happy to answer that. The way the RFP process generally works, and especially with this kind of short period, I think I picked out 5 or 6 firms that we sent out emails to, but the RFP process in general was open to anybody that wanted to respond. In fact, one of the 3 responses this year that we got was someone that we didn't expect. It was more of a local firm. And then we had a regional out-of-state firm plus Moss Adams that responded. As far as the fees are concerned, I don't have those right there or right here in front of me, but I think both years are around $129,000 to $130,000, plus or minus a couple of $1,000s. We do, for everybody's information, we do have a Chief Procurement Officer that's in charge of the whole RFP process. It's not something that I do myself. We have someone within the organization that's designated to actually handle the RFP and the correspondence and so forth. So that's how we got to where we're at now. Did I answer your question, or do you have more?
Mr. Chairman, who are the 3 or 5 that applied?
The 3 is Moss Adams, I. Bailey, which is an out-of-state firm, and then Hinkle and Landers, which is a local firm in Albuquerque.
Okay. The reason why I ask specifically, 1, it wasn't in the packet, and then 2, as we've gone through our RFP process, I know that SIC is very complicated, and there's not a lot of audit firms that actually can do a lot of the audit work that SIC requires or needs, both for our funds and for the outside funds that you help manage. So if this audit rule goes into place, I just have a little bit of concern and wondered what your guys' thoughts were on the idea of making sure you can get firms that are qualified to be able to do what is needed for SIC in the future.
Treasurer Montoya, that is a tremendous observation on your part. I can tell you, when we're scoring these RFPs, one of the things that we look at is their experience with entities such as ours. Moss Adams within the state probably does the majority of the investment agencies, and that's one of the reasons they scored like they did. I. Bailey, who was out of state, very, very good firm. They are regional. They had a lot of experience, scored a little bit less because they weren't in the state, but in the future, they're probably going to be right up there with the other firms that might be proposing in the future, because we are very focused in making sure that we have the experience that we need. And your observation is right on. I think the local firm, while it was a good local firm, it just didn't have the experience that you need for these alternative assets. Most any firm can audit stocks and bonds, but when you get into the alternative assets, it's much more complicated. And we have our eyes on that and continue to focus on it, and will continue to focus on it as we go forward.
Thank you. Thank you, Chairman. This really is an important subject matter for the SIC to keep our radar on. We're looking at it also on the pension fund side and in my office, because most can reconcile investments that Class A counties can do, but a lot of them do not manage any type of reconciliation on private equity, real assets, things like that. So it's just, and then it's nationally only a few that actually have that skill set that have been doing it for some time. So thank you very much, Brent. Appreciate it.
Yeah, Mr. Chair, if I could just add on, I think that all of these thoughts are really important. And in the audit committee, when we get around to maybe thinking about doing another RFP for more of a longer term contract, that we should have a conversation in the audit committee on evaluation criteria, because anybody that would have to respond to our RFP would have to meet the needs of evaluation criteria, and some of those things related to private equity and real specific fund level, fund universe, like amounts at the level of the SIC would be critical, that any firm shows that they could actually perform a proper audit in that way. So thanks for the feedback. It's important.
There is no further discussion on
Mr. Chairman,
these two items.
it's Stephanie.
Madam Wife, Commissioner.
Before we go to the vote, I just wanted to express my gratitude to Brent and Member Tejas and the audit committee for their time with the audits. There's a lot happening within the SIC, and the fact that these guys are willing to take this on and dig into the particulars of it. I'm very grateful for someone taking that on. So thank you.
Thank you. Any further discussion? Chairman Tejas, would you like to make the motion?
I don't have the paperwork in front of me. Does somebody else?
I'm happy to go ahead and do that.
Yeah.
For you, as the vice chair of your committee. I named myself that because I'm the only other member of the committee who left here.
Smart move.
Based on the recommendations of the Council Audit Committee and SIC staff, I move that the State Investment Council authorize a contract with Moss Adams LLP to perform the audit of the State Investment Council's annual financial statements for the fiscal year ending June 30th, 2024, and complete the agreed-upon procedures report for the 4 subsequent quarters as discussed, reviewed, and memorialized by the Council today. The term of the contract shall be for 1 year with the option to extend for 1 successive 1-year term. Is there a second?
Second.
I have a motion and a second. Brent, would you call the roll?
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Lola Montoya,
Yes.
CFA Secretary Wayne Probst,
Yes.
Nick Tejas,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
8 in the affirmative, motion passes.
Brent, item 5A, also an action item on our, I believe this is an annual action by the council on our Open Meetings Act resolution. Amy?
Mr. Chairman and members of the council, before you on page 362 of your materials, you have a proposed open meetings resolution, which would renew the open meetings resolution provisions previously adopted by the State Investment Council. It includes procedures for the conduct of public meetings by the State Investment Council and its advisory committees, and it is presented to you to meet a requirement for annual approval of procedures for open meetings. And with
Are there any discussions on our 2024 open meetings resolution?
Mr. Chairman, I had a couple questions.
Please.
Is this new, or is there a red line, or what was changed from the previous?
Madam Chair, nothing has changed from the previous open meetings resolution. So the provisions that you see for the conduct of meetings in paragraphs 1 through 9 on all pages are the same. There are no changes.
And Mr. Chairman, Ms. Amy, on item number 2 for the Governance, Audit, and Investment Committee, it says 10 days in advance of any meeting of the council's website. Is that the standard, or is that something that we can put down to like 5 days?
I believe the 10 days comes from a requirement in the State Investment Council's governing statutes, which require 10 days notice for State Investment Council's meetings, for the State Investment Council's meetings. And so that 10 days for the advisory committee simply matches that threshold.
Okay, well, you both are lawyers, but does that mean that the subcommittee has to be the 10 days, or can we actually decrease that? I'm just wondering, because on the governance committee, sometimes, like right now, we're going to be working on the investment policy and other items. Then we schedule, and then they still have another 10 days before. It just seems like it takes a lot longer to get things done when it's so lengthy.
Madam Treasurer, thank you for that question. I believe the 10 days notice is only a requirement to make a publication in the newspaper of general circulation that a meeting will occur, and that's also posted on the website. The actual agenda is not required to be posted until 72 hours in advance of the meeting on the State Investment Council's website. So the agenda can change up to 72 hours in advance of the meeting.
Okay, and then last question, Mr. Chairman and Ms. Amy, on the last item E, recordings of virtual meetings will be maintained by the investment office. Is it possible for us to add and upload it to the website, or are they uploaded?
Madam Chair, they are available on the State Investment Council website. There is a link for all public meetings that are held by the council. So that is currently available.
Mr. Chairman, should we add it to the policy?
Madam Treasurer, that would be at the will of the council. If the council wishes to add that to the policy, it certainly could be added.
What would you like to see?
I just thought that at the end of E, adding in and uploaded on the website. And the reason why I bring this up is because I know sometimes we've had live stream that hasn't always worked when we're in the meeting. So if it could be uploaded later, at least for transparency, so people can have access to it, that would be just another bonus for the transparency review that is done for governments or local entities that they make us have a score sheet for. So I just thought, since you're already doing it, adding it to the resolution could be helpful, but wanted to just see what the council thought or the staff.
Charlie, did you have a comment on that? Mr. Chairman, I would just remind the council that currently it is the council meetings that are broadcast and webcast. Our committee meetings have not been historically. Those are handled through meeting notes that are provided to the full council. But there are some technical issues that might prevent our committee meetings from also being broadcast in this similar manner.
Okay. I prefer for our committee meetings not to be broadcasted. I just was talking about our SIC public forum meetings, because I appreciate the raw conversation we have in our committee meetings. So I was just referring to the SIC, this meeting.
Council meeting.
Yes, sir.
Okay. Do we need to do anything on this, or we need to amend it or make an amendment, Madam Treasurer?
I thought on E we could just put and upload SIC meetings on the website. Just something real simple. so that it's clear that it's just the SIC public meeting that we all are in.
Okay, we have a motion, do we have a second? Sorry.
Second.
Mr. Chairman, may I suggest that under E, we, I make the revision right here, that recordings of virtual meetings of the State Investment Council will be maintained by the State Investment Office. So it's clear it applies to council meetings and not committee meetings.
Treasurer Montoya, that sound good to you?
Will that still allow it to be on the website?
Absolutely.
Okay.
Okay, we'll take that as a motion from Treasurer Montoya. Is there a second?
Second, Nick.
Any objections to that amendment to the resolution before we vote on the resolution? Seeing none, any further discussion on the resolution?
Motion.
We have a motion.
To approve as amended.
We have a motion by Treasurer Montoya to approve the 2024 open meetings resolution as amended. Is there a second?
Second.
I have a second by Member Sanchez. Brent, would you call the roll?
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
CFA Secretary Wayne Props,
Yes.
Nick Tejas,
Yes.
Don Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
State in the affirmative, motion passes.
Thank you, Amy. Appreciate it. On to item 6, closing matters. Do we have any old or new business that the council would like to discuss? Morning, this afternoon. Okay, our next meeting of the State Investment Council will be Tuesday, June 25th, 2024, here in Santa Fe, New Mexico. Item 7, do we have any public comment? You do, give Mr. Knowles. Good afternoon and welcome. If you would please introduce yourself.
My name is Kenneth Adorno. I'm with Invest New Mexico.
Welcome.
I was reviewing some of my notes on my computer the other day looking for something. And the first State Investment Council I attended was in September of 2006. And I was 3 governors, 4 terms. I'm sorry that the governors did not stay. I was hoping to hear my comments. I was here regularly. I spoke regularly. My 3 areas of interest for the public is that the community be as open as possible. I think that's been achieved with the webcasting. My criticism of it is during COVID, obviously, the public was not able to participate, and although the webcasts were done, there was no way to, at the end, have public comments. You had to submit your questions prior to, and how could you make public comments about a meeting that is not transpired? Public comments. And I don't know if there's ways of doing something, opening it up at some for a short point. I'd like to see a further outreach to our citizenship to understand that they can see these meetings and what these meetings are about. People don't understand what the state is. I talk to people all the time. I get Spanish Chambers legislative people, or hey, what's going on in the State Investment Council? I said, well, and on the hiring of the new SIC, I thought the last phase when there were just 4 finalists, I thought public input should have been included, it wasn't. Congratulations on getting the appointment. I think, the other point that I was very, interested is this investment council, really taking a more active approach in economic development. The fact that the new position comes from an economic development background is very, very, very positive. When the State Investment Council was trying to get approval from legislature on handling all these other funds, I opposed it. And I'm seeing what I fear. There's so much, each fund has its own needs, and each fund has its own regulations, and it all becomes intermixed. And I think the initial purpose for the land grant funds is somehow not being always given the attention that it needs. Now, you might need more staff. I don't know what that is. And my other concern was the fund itself growing at a rate that is such a huge fund. I always break the money. To me, this seems like a monopoly game. You know, give $550 million here, $250 million there, and then let's see how much money we make, and we give our little percentage out. But if you're giving more than the percentage, first of all, it's kind of contradictory because you have you guys are maximizing the investment, and the investment's growing, so it's how it goes. But anything above that 5% or whatever you're giving out should be returned to the public. The funds for the land grant is very much different than the funds for the other funds, because the other funds have a legislature that can always kick in money. This is all dependent on what is raised. I see the business of that as any business, as any corporation. Once they make their expenses and their commitments, those funds should be returned back to the stockholders or the stakeholders, which is this is the citizens of New Mexico. The governor has done some rebate programs. It could very easily be implemented. Now, it would take some policies. Do you set a target for the amount to secure the 5%? What I call as a businessman, my long-term debt. That's a long-term debt. But my profits, I should return to my stakeholders. Now, is this great? New idea? No. State of Alaska does it. You know, and I was talking with a friend of mine who works in California for their investment public employment. And he laughed. He says, you know, you guys have more money in New Mexico than I have. And I don't know if he does that. He says that. And he says, you know, they should be returning to the entities, to the people. And who are those people? Who were given the land grant back then? Spanish, Native Americans. I don't, you know, you can already go out, might have went to schools, money should be going to their pocket to offset that increased bill to feed the family. What you have to. So, you know, Microsoft came into it, and they ratified things because stock market used to be a dividend model. Now it's a racehorse model. I'm going to hold on to this and build it much, and when there's many racehorses with it, and then you can sell the value interest on the horse, right? It's not a dividend model. This should be you guys are a racehorse model, but you're never gonna sell the horse. You're gonna sell it, you know. It should be a dividend model, and I'm talking about the land grant part. Like I said, I opposed when they were proposing to have guys are great at investing money. All right, that's great. So bring some of this great this way, some of this money. But now when that group itself was created for something else. Now, take my comments, you know, they're just trying to be creative in looking at you know, I've been COVID, there are 8 out of 10 companies that I invested in. I'm invested in Romania now. We have a huge project in Romania. I'm making movies in New York. You know, just, I've never been able to I'm from Las Vegas, New Mexico, born where when I was growing up, we had outside toilets and dirt roads and no pavement, you know, and so I come from a different, you know, I see that my family, they lost a lot of the land grants, farms and stuff, and I say, those people, those families are still losing my land. There's investments, there's no dividends. Any questions?
Thank you very much for those comments. We appreciate those. I think you'll see over the next couple of months under new leadership at the SIC that we're going to be looking at a lot of the items you identified, including more robust outreach to New Mexicans to let them know what the SIC does and why it's important to the state. So anyway, I think a number of these items, Lee, that you've identified are important to the council. We appreciate your time coming here today. We also appreciate your longstanding interest in the council, so thank you very much.
My message got through after 18 years. Thank you.
I believe we are adjourned. Thank you.
Have a wonderful day, everyone.